Both parties want their little demonstration. My instinct is this probably goes on for about a week.
Refusing to release the BLS data is going to be a problem for the markets.
Probably this report is not coming out on Friday.
If we still have a shutdown, it could impact the Fed meeting, and that might be reason for people to pull back.
Even with the long shutdowns, you still have markets outperforming.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, entering a government shutdown. Congress blowing past the midnight funding deadline, putting some of this week's key economic reports on hold and leaving some investors focused on alternative jobs data. ADP is coming up later.
Yeah, look, this is Make ADP Great Again. This is the week where all of a sudden the alternative data sources take on a disproportionate amount of information, a disproportionate amount of clout in markets. Expect pretty significant trading ranges where you get both ADP as well as ISM manufacturing later this morning. They may be the last clean reads because tomorrow we're not getting jobless claims. And on Friday, we're probably not getting non-farm payrolls report heading into what will be a very fraught Fed meeting at the end of this month.
We did this back in 2013. We had a non-farm payrolls report that was delayed by a couple of weeks, and depending on how long this goes on for, we might be doing it all over again.
We are doing all over again. The question now is how long will this shutdown last? We are in a government shutdown, so you're going to see a number of workers that are going to be furloughed. The reason why this morning I am waking up with a little bit more of optimism that potentially this is going to be a short shutdown is we already see some Democrats caving. Overnight, you had 3 Democrats decide to vote for the clean continuing resolution the Republicans put on the floor. They need to just flip 5 more. When this starts to hit the D.C. metro area, do you think the senators of Virginia and Maryland are just going to sit back? Or are they going to say, no, you know what? Our constituents do not have work right now. They are not being paid. They can't go out, pay for their bills. We are going to vote to keep the government open.
It's quite a start to Q4. Let's talk about Q3. The final month of Q3, markets don't care about any of this. The strongest September for equities going back 15 years. The biggest month for debt issuance, the biggest September, I think, on record for corporate debt supply. And we closed out the month with the biggest leverage buyout ever in the history of financial markets. That is quite a September.
It sounds very risk-on. At the same time, you had the biggest rally for the month when it comes to gold for the month of September, going back to 2011. So definitely a different tone to all of this. But the market's wide open with the expectation that the economy will chug along and the Fed will keep easing into a vacuum, except it will not be a vacuum. And this is going to be really important at a time where the government's shut down and we're not getting those official metrics. How much more important will some of the earnings reports be, especially as they start trickling out with Delta and then JPMorgan and the rest? All of a sudden, that might be the most important kind of information that we get for setting the tone into the rest of the year.
I can't believe we're doing ADP guesses, but we are. So median estimate is 51K, highs 80, lows 25. This is the real deal. 8:15 Eastern time is ADP day. This Wednesday. From New York City, welcome to the program. Coming up this hour, George Goncalves of MUFG as we kick off Q4 with a government shutdown. John Lieber of Eurasia Group on why it's likely to resolve within 2 weeks. And Evan Seigerman of BMO Capital Markets as the White House inks a deal with Big Pharma. We begin this hour with our top story. The US government shutting down for the first time in nearly 7 years. Bloomberg's Laura Davison joins us now from the nation's capital. Laura, welcome to the program. What happened and how long is this going to go on for?
So at midnight, the government shut down. This means that, there will be almost no one working at the Bureau of Labor Statistics, no jobs report. There are some agencies that will stay open and keep operating with minimal staffing, things like the National Park Service. The White House has wide latitude on what they keep open, what they shut down. So it's very much a political calculus of sort of who do they want to pinch and where the pain points are going to be. In terms of how long this lasts, it's not clear yet. It looks like at least a couple of days. Senators are set to leave town for the Yom Kippur holiday. The House isn't even in town. And, right now it's still Democratic leaders and Trump, sniping at each other on social media. Once we get into the weekend, though, and into next week, it's possible we could see some daylight. We saw a couple Democrats join with Republicans last night to vote for opening the government. That if did not pass, they need at least 8 Democrats to join with them. But they've already got 3, getting 5 more. As the pain really sets in, as people aren't getting paid, as key services are delayed, that could start changing the minds of lots of senators.
Laura Davison with the latest down in Washington, D.C. Laura, thank you. More from Laura later on this morning, tracking this story. This is how it usually plays out. Goes on for a little while, Public gets sick of it, blames both parties, and someone caves.
Exactly. And right now, what you have at the moment is no party is fully blinking, but that is going to change because this is just going to drag on. And as I said, you have senators from Virginia and Maryland where their constituents are going to be directly impacted today, immediately, and that might flip some votes.
Which is why typically the market looks through it. So is it different this time? Here's the view on Wall Street. George Goncalves of MUFG writing the following. If a shutdown lingers, it will end up delaying upcoming economic data releases and likely dampen risk-taking. George joins us now for more. George, good morning.
Good morning.
I want to get to the final point there. Why will it dampen risk-taking? Do you sense that this is somehow somewhat different?
Look, so this is a year full of disruptions, contradictions. You guys opened up with how markets have been risk-on, climbing the wall of worry. Nothing really phases these markets. But there's always that moment in time where you're kind of compressing towards the end of the year, good gains. Maybe you use this as an excuse. It's a catalyst to say, you know what, take some chips off the table. It's been a good year. If this were to linger, it could be disruptive.
So it's just a theory that there's something potentially that could disrupt things, so you might as well sell. Does that actually fly for you? What would you actually sell if you're going to de-risk?
Well, look, I mean, you're already seeing the weakness in the dollar. It's your traditional macro products. It's going to be about a relative value play. Equities have had a great run. Let's not kid ourselves, right? So I do think that there's, again, let's see if this lingers. If it does, and it goes on to the weekend, I think it will matter.
I feel like every single month people are saying there is something that will matter because I'm nervous about valuations. Does that sort of work anymore, given the fact that the underpinnings of this have been proven out in the earnings, have been proven out in some of the investments, particularly from the tech giants?
Look, I mean, I think we can't conflate all that stuff. I think, again, as my point earlier, it's the time of the year. You have a lot of gains. This is where you could get defensive if you wanted to.
Do you think if the market takes a downturn, that'll be enough to maybe push Congress to actually act?
That's a great point.
The way the bond market pushed Trump to act in April?
That's a great point. So, I mean, I think risk markets here matter more. The dollar matters a lot, too. But, I mean, it only matters if it really changes the foreign flow, which has been largely coming in as a hedged flow. But if the dollar were to change, I think that would matter. And I think if equities take a turn. How much does it matter to the market that we're not going to get Friday's jobs report as of now? I mean, look, you guys were kind of poking fun at ADP, but ADP is, it has actually been proven to be a better predictor of what's really been happening to the jobs market. So maybe we might have a sigh of relief because NFP's been so wrong for so long.
Just to be clear here, that is a sport that a lot of people have enjoyed for a long, long time.
This is very true.
I was going to say, just to be fair,
not unique to any of us.
I don't think that we were poking fun at it. I think that in fairness, we are saying make ADP great because people are actually going to care about it. But carry on.
Look, but ADP has been a better predictor of what the true underlying weakness in the jobs market.
George says it's great
already. Yeah, exactly.
The confidence numbers from consumers aren't great. Jobs data hasn't been great either. Just in the last 24 hours, the quits rate, the lowest this year, consumer confidence, 5-month low. The share of individuals saying jobs were plentiful, the lowest since 2021. We've got a high confidence investor and a low confidence consumer. What's the credible argument for that dichotomy to persist?
I mean, it doesn't persist. I mean, unless you start to really place a greater emphasis on productivity and that the consumer doesn't matter in an economy that's a consumer-based economy, that means you think that you're changing how this economy operates. And maybe that's happening with AI and all the investments. But that's a little bit a bridge too far for me at this stage. I mean, it takes time to implement all these sort of new technologies. And we've put a lot of money into it. The consumer's still relevant. So if you kind of cut off the consumer here, I think that jobs market for me. Critical.
You think we're reaching the limits of looking through weak data here?
I do, because again, time of the year and the fact that we've been very nonchalant, complacent, there's lazy longs in a lot of different asset classes.
How about lazy longs in bonds? You didn't mention going into bonds necessarily. You talked about a potential weaker dollar. You talked about lightning risk. Are bonds the same kind of trade as they have been in the past during government shutdowns?
I think it depends on how long it lasts. I mean, I think past is not prologue, so we can't go back, and we haven't really had a long enough shutdown, and we'll see how long this one persists. But I do think the changing nature of flight to quality of the bond market has been with us for the last 18, 24 months, right? So I think this one would probably prove in the same direction that, the reach for treasuries probably won't be as strong as in the past. Because you have alternatives now. You could just sit in cash for longer. You could buy T-bills. So duration probably won't trade that well if this were to last, because it highlights the potential dysfunction that is concerning on the fiscal outlook, right? So I think that's all part and parcel. Again, it depends on how long this lasts. Maybe it's a nothing burger, and it's and we're gone by the weekend or before the weekend. But if this goes into the weekend, I think it's risk off, or and bonds could potentially be under pressure too, like the long end of the curve.
When was the last time you had this much or this little conviction?
Well, look, I think in general, investors are just, have been, and forecasters have been just going with the flow, right? And just operating with how markets, provide, short-term trading opportunities and being very tactical. I would say that this is, this is the new world we live in, I think.
Well, do you push back against that, against the flow? Is this the time to start pushing back against what has been a winning trade, which is stocks go up or
everything goes up? Yeah, no, I think we're in that sort of stage where I think it does make sense to be more discerning. I think it makes sense. Like, you had an amazing year, and you mentioned gold. Like, all of these different asset classes cannot be right. They're all going up for different reasons.
What else do you need to see to get to this point? The title of your note, it's still a reach for a Goldilocks outcome.
Because we haven't really seen it broaden out, right? It's been so concentrated, and like the sort of capex, the sort of performance that's been so concentrated in tech, it masks the reality. And John was mentioning it before. The consumer cannot be this pessimistic, and somehow we're going to have like the start of a robust cycle. That means that we're still on the tail end of the consumer side, and tech operates in its own planet.
I just want the sound effect again. That's all I want. You're having quite a week, aren't you? What was that one? Burr. Is that the money printer?
Yeah, money printer go burr.
Right, okay.
That's just essentially.
Right.
But yeah,
you think it's got like a very kind of Latino, like a brr.
Yeah, George agrees.
Yes, you do.
For me, all I can say is that's what I think about every day when people have this lack of conviction, and it's just buy stocks.
That's what gold thinks too, right?
Yeah. Brr.
I know we get comfortable around this table sometimes. Just to remind you, we are live. George, it's good to see you. Thank you. Can't redo this. George Goncalves of MUFG, thank you very much. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, Vonnie. Yes, thank you, John. Good morning. Well, as you guys have been discussing, Congress blew past a midnight funding deadline, triggering the first government shutdown in nearly 7 years. The White House's budget office ordered agencies to begin executing their plans for a funding lapse. The shutdown will disrupt hundreds of thousands of jobs, upend many public services, and lead to delays in key economic data. The White House has pulled the nomination of E.J. Antoni to lead the Bureau of Labor Statistics. His nomination showed signs of faltering due to criticism from senators and economists. A White House official said the administration looks forward to nominating a new candidate soon. Bank of England Deputy Governor Sarah Breeden warned of the threat to the economy posed by leaving interest rates higher for too long. Breeden said that efforts to stamp out a fresh spike in inflation by holding borrowing costs in restrictive territory come with risks in the other direction. And that is your Bloomberg brief. John.
Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. Sticking with the Bank of England, Catherine Mann, a member of the Monetary Policy Committee, speaking at Bloomberg's Women, Money and Power event over in the City of London. Bloomberg subscribers can tune in to the interview on Live Go on the Bloomberg terminal. Up next on this programme, we're playing the blame game.
Republicans are plunging America into a shutdown.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns.
A conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning. Shutdown, day one. Some economic data might be compromised by this. I'm sure you're familiar with the story. So this is the week ahead for the economic data. We will get ADP later this morning at 8:15 Eastern Time. Look out for the PMIs at 9:45. The ISM as well. Super, super important. Big question mark around jobless claims and around payrolls. Jobless claims and payrolls are super, super important for this Federal Reserve. Just where is this labour market at a time when FOMC officials at the moment are super divided on what to do next?
Yeah, and as you were mentioning earlier, the JOLTS data that we got yesterday, the job openings data, which is the last official data point that the Fed may get before their meeting at the end of this week, showed the same kind of inconclusive market that we've been talking about. The idea that the actual number of job openings came in higher than expected, actually rose, but when it came to the quits rate, it tied with the lowest rate going back to 2020. This is not a dynamic market. This is a stagnant labor market, and it has a lot of concerns and red flags around it.
Got a low confidence consumer. Pair that with a high confidence investor. There's something got to give in Q4. Equity futures to kick off Q4 look like this. We're negative by 0.5% on the S&P 500. On the Nasdaq, we're down by 0.6, following a 3-day winning streak on a benchmark closing out Q3. In the bond market, 2-year, 10-year, 30-year. Focus on the front end of the curve just for a moment. 360 on twos. We just closed out the quarter. The 2-year bond yield down for 3 consecutive quarters for the first time, believe it or not, since 2020. That story, though, has started to stabilize. I think people coming to realize just how divided this committee is on how far they're willing to take things and how quickly they're willing to cut again.
On one side, you've got Governor Myron, you have Mickey Bowman, you have Chris Waller, although he's been really quiet, which is notable to me. Then you have a mounting number of other Fed officials, and yesterday adding to the rolls, Lori Logan of the Dallas Fed coming out and really putting the emphasis back on inflation, saying the combination of persistent inflation, resilient demand, and modest labor market slack indicates to me that policy is likely only modestly restrictive. There may be little room to make additional rate cuts. This flies in the face of getting down to 2% in quick order, which is possibly the reason why you're seeing that stagnation in the 2-year.
That's next meeting for the Federal Reserve at the end of October, the end of this month, October. Unreal. Under surveillance this morning, we're playing the blame game.
Republicans are plunging America into a shutdown, rejecting bipartisan talks, pushing a partisan bill, and risking America's health care.
We're doing well as a country, so the last thing we want to do is shut it down, but a lot of good can come down from shutdowns. We can get rid of a lot of things that we didn't want.
So here's the latest this morning. The Senate failing to reach a deal to extend funding, plunging the US government into a shutdown, putting a slew of economic data in jeopardy. John Lieber of Eurasia Group writing the following: even a macroeconomically insignificant shutdown could have knock-on effects that delay data releases for the next several months as federal workers get up to speed. John joins us now for more. John, welcome to the programme. I want to pick up on the language of the president there, that last line. We can get rid of a lot of things we didn't want. Is this going to be a different kind of shutdown?
Yeah, absolutely. I mean, I think the fact is that Trump is playing a different game by a different set of rules than I think the Democrats on Capitol Hill are playing right now. And he's been playing that all year, and he's been playing that for his entire political career. And I think that there's a lot of unpredictable effects that are going to come out of this shutdown that we haven't seen before. If you look at the pattern this year, it's that Congress's authority has been usurped or even eliminated in many cases when it comes to decisions about what the federal government's doing, who they're funding, whether or not they're laying off workers or even closing entire divisions, and Congress has been helpless to stop it. So part of the reason the Democrats are behind this shutdown, are rallying behind this shutdown, is because they want to force the power of the purse back over to Congress. But I don't think Trump cares. And again, he's playing a different game. He now has the power to choose who's essential, who isn't. He's going to take that opportunity in a way I don't think we've ever seen in the United States before, and deem the functions that he prioritizes as essential and then cut off the ones that he doesn't. So this is a very different type of shutdown than we've seen before. Even the one that Trump oversaw in 2018 and 2019, the government was partially funded then. So you had the core defense functions and other security functions had an authorization from Congress to keep spending money. Right now, nobody does. So Trump's in charge, and he will be in charge until the Congress agrees to reopen the government.
Does this administration try to make furloughs actually permanent?
It could try. I mean, I think that's a decision that's up to the courts. I mean, one of the interesting phenomenon so far this year is that the courts are awfully slow, and the Trump administration could be pretty quick. So they could use this as an excuse to try to furlough more workers. You know, there's been some resistance to those furloughs, even within the cabinet agencies that are run by Trump appointees, because they want the people to do the work they're supposed to do. But now they suddenly have an excuse, and clearly the White House sees a political advantage in forcing more of these layoffs in order to bring Democrats back to the table, and I expect that they're going to use it.
Well, John, 3 Democrats already back at the table last night in the sense that they voted for the Republican clean CR. They only need to get 5 more Democrats to then reopen the government and keep it funding to the end of November. Do you think that Schumer is losing the moderate wing and potentially this is going to be a short shutdown?
Could be. I mean, you know, your base rate here, your expectation should be that this is a relatively short shutdown. because of these political pressures on members of Congress who don't want to see this happen. And the only thing you need is exactly what you said. You need 7 Democrats to say, we've had enough. We already know the universe of those 7 Democrats. They're the ones that voted to keep the government open this spring. And you mentioned Schumer. He's the one who's under the most pressure because he took just withering criticism for his decision to keep the government open. But the fact, and he's under a lot of pressure from the Democratic base to regain leverage over President Trump, leverage that simply doesn't exist through Congress right now. And so I think that he's in a really tough spot. Those other Democrats, I think this is an easier calculation. People like John Fetterman from Pennsylvania see that this is a tough thing for the Democrats to win. And over the next week or so, I expect those numbers are going to grow. And that will help to end the shutdown probably sooner rather than later.
That actually is exactly where I wanted to go, John. This idea of in March, what happened to Chuck Schumer when a lot of people, Democrats in particular, said caved to the Republican demands to keep the government open. Is this just performative to avoid that, to placate a certain side of the Democratic base? Is that how it's being read, at least in polls?
Yeah, I mean, I think he's in a tough spot, and I feel bad for the guy. There's no way to win this thing. Like, he's got to keep his eye on the Democratic members who elected him to be leader. He's got to keep his eye on the Democratic voters who elected him to his Senate seat. And the fundamental problem for the Democrats right now is they don't have a strategy to push back on Trump. That they've been unable to land any punches, and they've been unable to draw any blood. His popularity is reasonably high for President Trump. He's hovering around the mid to low 40s, which is much better than he was doing in the entirety of his first term. And he's doing all kinds of controversial stuff that the Democrats hate, and they can't articulate the case against him. And until they figure out how to do that, Schumer and the other leadership are going to be looking for things like this that allow them to kind of shore up their base on the left and placate them a little bit and try to land these punches that so far they've been unable to do. I think this is a prime example of that.
John, the markets largely don't care. Do voters care? Has there been anything in the voting or the polling that shows that this is swaying the needle in any capacity?
I suspect at some point the chaos will be enough and people will say, you know what, we don't like either of these jerks that are causing all these big problems. That's kind of where I think this ends up in the polling. I don't think it necessarily falls on the Republicans or Donald Trump. I don't think it necessarily falls on the Democrats. Maybe the president takes more responsibility because he's the executive. But, if you look at the elections, there's no evidence that these shutdowns, as we talked about last week, there's no evidence that these shutdowns make any difference in the elections whatsoever. In 2013, the Republicans were solely responsible for, at the time, a very long shutdown over Obamacare. And in 2014, they won back a majority in the Senate. So there's just no evidence that this has lasting political effects. I think it could be a drag on the overall approval rating of lawmakers in Washington, but I don't think either side's going to win or stands a lot to lose here.
John, do you think it's time for new leadership in the Democratic Party?
Probably. I mean, I don't think there's anything, I think that being a leader is a tough job. I think it's a hard thing to do. They have a new leader in the House and he's doing his best. I think in the Senate, I wouldn't cast aspersions on these guys. I used to work for the minority leader in the Senate and for the Republicans. And it's a tough job. It's a tough job keeping everybody happy. But, the Democrats are not articulating the case against Trump and their leadership is not helping them do that. So I think looking to Congress for your leadership right now is a mistake. And if I were the Democrats thinking about the next leader of the party who's going to be running for president, I'd be looking out to the states, to the governors, to people that aren't currently playing on the national stage in the way Schumer is. Schumer's got to do his own tough job managing his own caucus and playing the inside Washington game. And then these governors that are out in the states are the ones who I think will be the more effective messengers against Trump eventually.
John Lieber of Eurasia Group. John, thank you, sir. Appreciate it. Such a strong final point about the future of leadership of that party.
And there's a lot of swirls around about Chuck Schumer's, not just his leadership, but his seat in New York. Point blank yesterday, Alexandria Ocasio-Cortez was asked, are you going to primary challenge him? And she said, look, a lot of Republicans think the shutdown is because I might go after his seat. They should come talk to me directly. Come to my office, she said.
If you're just joining us, welcome to the program. Welcome to our office. Futures negative by 0.5%. Up next, Amy Falls of Northwestern University, managing one of the nation's most valuable endowments. That conversation just around the corner. Goodbye Q3, hello Q4. Equity futures on the S&P 500 negative by 0.5% following a 3-day winning streak. On the Nasdaq, we're down by 0.6. What a run through September. For the third quarter, the S&P up by 7.8%. The Nasdaq 100 up by 8.8%. The Russell over the 3 months. The bulk of the move came in August. But for the third quarter, the Russell up 12%. In the bond market, 2-year, 10-year, 30-year, Lisa and I were talking about what was happening at the front end of the curve, 360. We've had 3 consecutive quarters where 2-year bond yields have been falling. Again, the bulk of that move actually came in August following that really weak July jobs report. But that move in the bond market just unleashed another leg higher for gold. Gold, 4-day winning streak into Wednesday. Make it day 5. Up again this morning by close to 0.75%. We're staring down the barrel of 4K on gold. Gold on the quarter had a 17% rally. Gold on the month was up 12%. That is the best monthly gain going back to 2011 for the yellow metal.
Last night I was listening to a podcast about gold because I was so inspired and about why Spaniards loved gold back in the 1400s. I know you're rolling your eyes at me, but it was because it was physical and they could actually take it with them. And there is this idea that you cannot take the hopes and dreams of the economic progress of a nation with you in the same kind of way that you used to. The dollar, well, guess what's happening down in D.C.? The euro, well, check out France. And so this is the reason why gold keeps climbing, even in the face of people saying, it's just a rock.
Just for the record, I wasn't eye rolling. Someone else around the table was. Just in case. Just in case. You do a great eye roll. Mine not so much. 3 hours away from the opening bell. Let's get you some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Lithium Americas. Shares are surging 33% in the pre-market after Energy Secretary Chris Wright confirmed here on our network that the U.S. will take a 5% stake in this company and a 5% stake in its Nevada mining project, home to the largest lithium deposit in the U.S. It, of course, marks the latest example of the Trump administration making investments in critical areas of the economy as it seeks to boost domestic production and cut its reliance on China. And moving on to the power company AES, shares also moving sharply to the upside, up 13%. As we report here at Bloomberg that BlackRock Global Infrastructure Partners is in advanced talks to buy the company. AES is valued at $38 billion, including debt, but it has lagged its peers in the utility space, making it right for a buyer, betting that AI will continue to drive electricity demand. We're reporting that an agreement could be reached as soon as this week. And Nike, finally, its comeback bid is finally gaining traction. Shares are up 3.5% after sales came in much higher than analysts were expecting. That's because some of its initiatives, like focusing on performance and running and re-engaging with some of its retail partners, are finally starting to take hold. But there are still hurdles, with Nike saying it expects a hit of $1.5 billion due to tariffs this year. That's much more than the $1 billion it was previously projecting. John?
Yahara, thank you. More from Yahara in the next hour. We'll catch up with Adrienne Yih as well in about an hour from now to talk about the latest with Nike. Nice beat from them. Nice move in the pre-market. On our radar this morning, the US government shutting down. Congress failing to meet a midnight funding deadline, halting non-essential services. This is the third shutdown under President Donald Trump. Elsewhere, Taiwan rejecting a US proposal to move chip production stateside in order to cover half of America's demand. The Taiwanese vice premier saying the idea came from DC and his country will not agree to the conditions. And finally, the White House withdrawing the nomination of E.J. Antoni to lead the BLS. President Donald Trump named Antoni for the role after firing the commissioner. Officials saying they will nominate a new candidate very soon.
So his nomination was on the ropes because before you get to the Senate floor, before you get to a hearing, you have to get through a committee. And we already had Senator Lisa Murkowski a couple weeks ago say the committee expressed, quote, extreme reservations about him. So already that was happening at the committee level, and you can't lose the Republicans at the committee level because you for sure know you're going to lose the Democrats. So his nomination on the Hill was already on the ropes. And this comes after economists on both sides of the aisle, even conservative economists, saying, actually, we don't have faith in this individual. We don't think he's the right person to lead the BLS.
So this story's kind of slipped under the radar, but I think it's more important. Important not just for the BLS, but also for the process underway to select the new Fed chair. There is a history of Republicans pushing back on the president when it comes to the Federal Reserve. We talked about Stephen Moore in his first term, nominated for a seat on the Fed board, had to be pulled. This happened here with the BLS. I think keep that in mind if you're really worried about the independence of the Federal Reserve and who might be appointed, nominated by the president and the Treasury Secretary through this process. This is another example that Congress will flex its muscles now and again.
And this is another example of how the market has an upper hand in pricing out some of the political risk that pundits talk about, because markets never were that concerned about E.J. Yih-Tennant. They were talking about the likelihood that he wasn't going to get through because of a slew of issues that were really coming from both sides. As a result, they didn't see this as a real problem. And they are looking through the sort of questions around independence with the Fed for the same reason. So maybe point for markets.
The market gets a vote. And this time, it didn't even have to vote on this particular issue. We'll see what happens with the Federal Reserve later this year. Let's turn to investing. Demand for private markets rising as investors seek a slice of the booming $13 trillion asset landscape. Northwestern University among the institutions navigating the shifts in asset allocation, with one of the nation's most valuable endowments topping $14 billion just last year. Joining us now is Amy Forbes, the Chief Investment Officer at Northwestern, from Bloomberg's Women, Money and Power event in the City of London. Amy, welcome to the programme. It's great to get some time with you. Typically, we wouldn't begin a conversation with you by talking about cash, your cash allocation and liquidity needs, but I think we have to start there, Amy. What are your cash allocation looking like now? What does it look like, and how's that changed compared to years gone by?
Yeah, it's a little higher. We have about 7% of the portfolio in cash or very short-term treasuries, and that's higher than normal, and also the duration of the treasuries is shorter. Reflecting a lot of the operating uncertainty that we want to be prepared for.
Amy, when did that start? When did you start stockpiling or adding to your cash holdings? Was there a trigger that really prompted that shift?
I think it's a combination of things. We started around December of last year. There was a moment where I was thinking about redeploying, and that would have been around Liberation Day. But I think the combination of operating uncertainty and at that time relatively fully valued markets, similar combination to at this moment where I think markets are pretty fairly valued and there's a lot of uncertainty in the economy and there's operating uncertainty at the university, it just makes sense to have a little bit more dry powder, and the risk of not being in the market seems less extreme, and of course it helps to have relatively high rates on short-term treasuries. So all three things are supportive, I think, of having a little bit more money in your back pocket.
Amy, you talk about some of the moments where you flirted with getting back into the market. I wonder how much you were influenced by some of your peers at other universities who had huge allocations to private markets that they couldn't quickly liquidate in when they needed some cash. If that sort of encouraged you to hold on to more liquidity as well, whether that encouraged you to stay away from some of that aspect in terms of redeployment.
I think it's really important. Seth Klarman used to talk about the option value of cash. And I mean, I think it's harder to measure, but it is very important to have enough liquidity to redeploy into opportunity. We do have a big private equity allocation, and we've actually been growing it over time. But I think a barbell can be quite helpful in that you want to be opportunistic, and then you also want the long-term benefits of extremely long horizon investing, which I think private equity still represents.
What does the rest of the year look like given the cuts of federal funding from the Trump administration to universities like Northwestern?
We are looking hard at how to respond to a changing funding environment. I think there's many aspects to that. From an investment standpoint, we do have to continue to work on generating high returns. We are 25% of the university's budget. I don't see that going down anytime soon. And so we are stuck in a hard place of wanting liquidity, but also wanting high returns. So we are definitely barbelling in terms of how we respond in the investment.
Federal grants remain frozen as well by the Trump administration. Is there active outreach between the university and U.S. officials?
Yeah, I am probably not the best person to comment. I believe there is conversation.
Amy, just to build on this barbelling, though, I think this is really interesting. How you balance the move into alternative strategies with the increased liquidity needs because of the operational environment. How are you and the team confronting this moment? Does it make it difficult to lean into those strategies, or do you have to remove money from, say, your public market allocation to fund those needs?
Yeah, I think you have to have margin. I think the important thing is to be really clear why you're giving up liquidity and where, and you have to believe you're going to get the higher returns. One thing that we have been doing is looking further down the market capitalization of private equity as we see the probability of more money through retail and other products coming in at the high end of private equity. We think the better returns may be migrating down to middle and lower middle market private equity. So we just want to be sure that we're getting paid to give up liquidity because it is valuable both for rebalancing and for meeting the needs of the university. I think there are areas of the market like large cap U.S. stocks where it may be less important. You can probably use an ETF, and we've done a little bit more of that where we believe you can use options or ETFs to put that exposure on. You don't need to lock up capital as much.
Amy, you talked about getting to the lower end of the private equity sphere, lower and middle market companies. I'm just wondering if you still see private equity as a source of returns over, say, private credit, where there's been so much interest, so much money, the discussions around the golden age of income.
Yeah, private credit is a very viable asset class. I think we have a 5% spend rate, so something with a 9, 10, 11% expected return is good. I think you have to think about returns net of defaults, and we haven't really seen a default cycle. So, I don't think you put all your eggs in the private credit basket. I do believe in ultimately earnings growth does drive returns over the long term. So what we want to invest in is companies that can generate good earnings growth and capital that will seek companies and make sure that the management teams are rewarded for investing in high ROIC projects. So I think there is real opportunity with smaller and middle-sized companies to generate earnings growth with the right capitalization, the right management, and the right investment partners. So we believe in both, and I think we are exposed to both. Right now, we're probably a little more focused on deploying new capital into middle market private equity, but there's nothing negative about private credit. I think it's just the spreads are probably pretty fully priced right now.
Amy Falls. Amy, appreciate your time. It's great to do this, and hopefully we can do this around a table in New York sometime soon.
Thank
Amy
you
Falls
so much.
Of Northwestern University. Amy, thank you very much. When you're 25% of the university budget, and there's a real risk you might become a bigger proportion of the university budget, you've got to account for that. Amy's in a tremendously difficult position. A lot of people running endowments right now are. You've got to have that bar that she talked about. You want to shift into alternative strategies, but if you give up that liquidity, you need the returns. At the same time, you need liquidity, so you're sitting at the front end of the curve. Problem you've got from here is that the interest rates are going to start to come down. So you've got a decision to make. What do you do with that position? Do you have to extend duration? Do you have to think about doing other things? They're going to get squeezed more and more, potentially by both the regulation and what's happening with interest rates.
Yeah, and the policy uncertainty, because they don't know exactly what's going to come down the pike, what grants are or are not going to come through, what strings are going to be attached, sort of what we saw with Harvard and the $500 million pact that they seem to have agreed with President Trump to provide a lot of training to trade organizations, trade schools. There's a question here. How do you remain liquid at a time where so much of your investment has been seeking for yield and illiquidity? And we have already seen that with forced sales of private credit, private equity from the likes of some big universities already. So a really interesting moment. Fascinating. She's betting on middle market private equity at a time where there are a lot of questions around the economic growth of this country.
Amy Falls of Northwestern University. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you so much. Dallas Fed President Lori Logan said the central bank should be cautious about cutting rates further. Logan supported the Fed's rate cut at its meeting last month, but said the central bank should be cautious in considering additional cuts while inflation remains above target and the labour market relatively balanced. President Donald Trump says his administration is close to finalizing a deal with Harvard University. Trump initially accused Harvard of failing to tackle anti-Semitism on campus, but later broadened that to include allegations of political bias. Warren Buffett's Berkshire Hathaway nearing a deal to buy Occidental Petroleum's petrochemicals business. The Wall Street Journal reporting Berkshire would pay $10 billion, including debt. If successful, it would be Berkshire's largest deal since buying reinsurance company Allegheny in 2022. And that's your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, the art of the deal.
Today, Pfizer is committing to offer all of their prescription medications to Medicaid, and it will be at the most favored nation's prices. Pfizer will invest $70 billion to reshore domestic manufacturing facilities. They're all coming in over the next week. We're making deals with all of them.
Up next, Evan Seigerman of BMO Capital Markets. He's going to explain just what is Trump RX. That conversation up next from New York City. You're watching Bloomberg TV. Kicking off October on a low, we're down by 0.6% on the S&P, down by 0.7% on the Nasdaq 100. Under surveillance this morning, the art of the deal.
Today, Pfizer is committing to offer all of their prescription medications to Medicaid, and it will be at the most favored nation's prices. Pfizer will invest $70 billion to reshore domestic manufacturing facilities. They're all coming in over the next week. We're making deals with all of them. And I said, if we don't make a deal, then we're going to tariff them an extra 5, 6, 7, 8%, whatever the difference is, and we'll take it that way.
So here's the latest this morning. Pfizer striking a deal with President Donald Trump to sell some drugs directly to Americans at a discount. Evan Seigerman of BMO has an outperform rating and a $30 price target on shares of Pfizer. He writes the following: the announcement serves as a positive to the biopharma sector. The deal seems to set a path for other pharmaceutical players to follow, allowing for headline pricing concessions and a Trump win. Evan joins us now for more. Evan, welcome to the program, sir. So I'm going to challenge you with this. The direct-to-consumer effort, Trump RX. Evan, can you explain how this is going to work and how effective it might be?
Well, it's still TBD as to what this actually will be. Apparently, it's a website that's launching next year that allows, direct-to-consumer sales of many pharmaceutical products. There's no website yet. I don't think, there might be a Trump RX website if you go to, but it's probably just a landing page. We have seen some DTC efforts, mainly with the GLP-1s, like with Lilly Direct. So there is a model, but expanding it beyond that is a bit of an unknown. It is a bit reminiscent of me when the government was trying to do the Affordable Care Act marketplace exchanges, and that really didn't work out well. So we will see what happens here.
Evan, when they go direct to consumer, can you just help people understand what happens with margins when they drop prices? Are margins maintained? What happens?
So, a great question. So margins are actually maintained, and a lot of the drugs that they were discussing with Pfizer are drugs that are not significant to their, top line or are declining in terms of revenue contribution. So you say you have a drug with a list price of $1,000. No one actually pays that. PBMs don't pay that. So if you're giving a discount of 30, 40% and you're passing that through to just a consumer on a direct-to-consumer basis, nothing really happens to margins. You're unlikely to see the big ticket oncology products in a DTC market, right? You're not going to get a $200,000 per year cancer drug that's given at a hospital via this channel. It's more for the tablets, like with Lilly Direct for GLP-1s, for inflammation, for, more primary care conditions.
So is this essentially just cutting out the middleman, getting rid of, say, the Caremarks, the CVSs? Should this hit that entity much harder than the actual pharmaceutical companies?
I would say so. And if you hear commentary from Dave Ricks, actually, he highlighted, I believe, on the second quarter earnings call, his concern and frustration with the middlemen and how they inflate prices and really just make it very challenging for patients and consumers to get access to these products. Because if you think about it this way, you have a drug, again, for $1,000. The middleman gets that rebate and discount of $500. That savings doesn't necessarily go to the end user. It's absorbed by the system. So I think a Trump RX or DTC platform wants to get that discount right to the patient so they're not paying a ton out of pocket. The issue is we all have insurance plans, and if we're not going through the PBMs, we don't get our deductibles and out-of-pocket maxes, so you're kind of not getting the full benefit of your health insurance. That's a different debate for a different day, but probably something to think about as well.
Well, but is that part of this debate, right? I mean, this is essentially a question of why can't we just have a simpler system where things cost less? I mean, it's a pretty basic argument. Why haven't we done this sooner? And it comes down to, sure, the OEMs, and it has to do with the middleman, but it also has to do with the insurance structures and how we get premiums and all those forms that everyone hates filling out. So is this a first step to that, or is this essentially a nice prophylactic move that doesn't actually move the needle because of all of these other complications?
Unfortunately, I think it's the latter, because in reality, if you want to change the system, you need true PBM reform. You need to really look at the rebate and discount structures, because while this is a nice headline and there's going to be some drugs available online, it's not going to be the entire pharmaceutical kind of ecosystem. And I think you really need to understand what's driving cost increases in healthcare, insurance, for example. And I'm not a managed care analyst, but I've been reading headlines about how, health insurance premiums are set to rise 10% in the commercial space, 70% in the ACA kind of marketplace spaces. So that's a real problem. And I think that's going to hit folks next year. So if you want sustainable kind of, accessibility and dealing with costs, you got to look at the PBMs and the insurance companies.
Pfizer also agreed to spend $70 billion in domestic manufacturing facilities. Is this the blueprint for other pharmaceutical companies if they want to avoid Trump tariffs?
For sure. And, I think it's important to note all of the companies that I cover, including Novo Nordisk, have significant U.S. manufacturing operations. So they're constantly investing both manufacturing and R&D in the United States. So it's not necessarily it might be a new headline announcement, but they were probably planning on doing it anyways. I don't just see them coming out one day and saying we're going to invest an additional $70 billion without having thought about it previously.
So is there even a risk anymore of tariffs in the pharmaceutical sector?
I never thought there was a real risk of tariffs outside of the 15% bilateral kind of trade agreement that the U.S. and Europe has on some products. When we saw the 100% tariff kind of headline from Truth Social last week, I said that was more bark than bite, because, again, all these companies have significant manufacturing presence here. I think that there could be some tiny bit of, some tariffs on, imported API, which would be 15% on a portion of cost of goods sold, which really would be inconsequential when you're looking at the cost of a pharmaceutical product.
Evan, can I just nail you down on a number just quickly? When Annmarie talked about that, was it 70 billion? Mm-hmm. 70 billion investment promise. How much of that was already going to be allocated?
Well, I have to go back and check my notes. Probably pretty much all of that, because you're not going to come out one day and just say we're spending 70 billion. This is long-term planning. And they were probably able to think about it over the past years. They're doing their budgets and then come out and say, hey, we're doing this for you.
Thanks for clarity on that, Evan. It's important. Evan Seigerman there.
Very important, of course.
Vivek Capital Markets. Evan, thank you. Thank you very much.
Yeah, this is sort of the story with a lot of the companies, right?
Yeah.
I mean, they can't just announce $500 billion investing plans overnight without already having some of this allocated.
But they have to add to it. Apple already had, I believe, $500 billion, and they added $100 billion to go stand alongside the president in the Oval Office and say, we're adding more manufacturing and adding more money and investment into the United States.
Unless you're Jensen, of course. Jensen apparently can just pull that money out of thin air and make big promises.
But then he also can go out and make deals overseas, and he can dance to his own music. I mean, this is sort of the single-handed agent around the world. I want to see a biopic about Jensen Huang. Please, let's get on it.
Oh, like a movie?
Yes, absolutely. Okay. Like a movie about how he regained it. I think that would be
Who's
fascinating.
going to play him? You got an idea?
Ooh.
Take some time.
I will.
You ever think about that?
Thank you.
Share it in the next hour. That's your big tease. Thanks. Coming up alongside that, of course, we'll have some guests. Michelle Weaver of Morgan Stanley is going to join us alongside George Pollack of Signum Global, the former White House trade official, Kalutkiewicz, and Adrienne Yih of Barclays. Adrienne talking about the latest with Nike. Decent numbers from them. The stock is higher in the pre-market. The broader market to kick off the month of October and the final month of 2025. Hello Q4. Equity futures negative by 0.6% from New York City. The second hour of Bloomberg Surveillance is up next.
The amount of euphoric behavior in the equity markets is extremely high right now.
There is still so much liquidity in this market.
The earnings situation we think is excellent.
Our businesses are having very strong years. With a little more certainty, they'd be leaning in more.
Long equities and long gold has worked very well for us, and we think that will continue to work.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P 500 pulling back from a 3-day winning streak. We're down by 0.6%, closing out a 5 month winning run. On the Nasdaq, we're down by 0.7. In the bond market, the 2-year stabilizing around 360. 3 consecutive quarters of falling yields at the front end of the curve. That story stabilizes going into the next Fed meeting. We might be light on economic data, at least for this week. Payrolls is due to come on Friday. Claims is due to come on Thursday. We're in a government shutdown. We might not get those numbers.
So what we will get is ADP, ISM manufacturing, and that will come today. So today actually might be the most important day of data that we're going to get this week. And right now, what's interesting to me is that it is a Rorschach test. You can look at this market, you can look at this economy and see weakness. You can look at this economy and look at this market and see great strength. And you have Fed officials on one side seeing one thing, Fed officials on the other side seeing the other thing. And it is unclear where they are going to come out because we've heard a lot of Fed speak and it shows a lot of division on a Fed looking at the data very differently from one another.
And yesterday, Lori Logan talking about how there's still a lot of this concern about inflation. We might not get the next CPI print. That's October 15th. The issue we have with the shutdown is we don't really know the timing of it. Is it going to persist through the weekend? Is it going to be a 2-week shutdown? Is it going to be 35 days, which is sort of 2018, 2019? I woke up optimistic, as I said in the last hour, because 3 Democrats decided last night to vote with Republicans on the CR. They just need to flip a few more. And what do you do with the senators in Virginia, in Maryland? All 4 of them are Democrats when their constituents are furloughed and they want to get paid and they're not working. They're going to have to say, all right, we're signing up for this. It's over. The fight's over. We capitulate.
The financial markets are already optimistic. The September we've just had has been absolutely historic. We've had record highs across the board on the S&P, the Nasdaq, on the Russell. We've had record debt issuance for the month of September for corporate credit. We've seen the tightest credit spreads on investment grade in multiple decades for high yield near the tights of the year. We've just seen headline after headline that speaks to a market on fire, and yet we've had this conversation about a Federal Reserve that's cut interest rates once. It is about to do so again, and maybe again and again.
This is a confusing moment, and I keep thinking about what Peter Scheer said with the I-shaped economy, where you have the bulk of the economy, and then you have this little eye that is so bright, and a little dot is so excited, and that is AI, and that's all these big companies that can profit from wealthy individuals who can keep on spending. And it raises the question, the Fed has one tool, it has the rate instrument, it has the balance sheet, it has a couple tools, but they address the same issues, and they're trying to solve for something that is fundamental to this question of how do young people get jobs with AI? How do you retrain people? How do you get people into the labor market? Things that are difficult for them to address by lowering rates, and yet they're seeing weakness in those areas. It is a confusing moment, and the data is reflecting that.
This year's flying by, isn't it?
It is.
October. 3 more months to go. Equity futures negative by 0.5% this morning. Coming up this hour, Michelle Weaver of Morgan Stanley with Wall Street closing out a strong September. George Pollack of Signum Global as a government shutdown begins. And Adrienne Yih of Barclays with a surprise beat for Nike. We begin this hour with stocks sliding as investors weigh the impact of a data delay. Michelle Weaver of Morgan Stanley sees tension growing between the Fed and markets, writing last year the Fed cut 50 basis points when it was concerned about a weakening labour market. Yet today, the data is even weaker. Michelle joins us now for more. Michelle, good morning. Good to see you.
Good morning. Thank you for having me.
You and the team have written about the need for speed. Mm-hmm. Is that the risk now that this Fed doesn't respond quickly enough?
Yeah, absolutely. I think the market is now really anticipating these rate cuts. Our economists expect us to get another 125 basis points total between this year and next year. And I think if with the shutdown, with some of the government data delay, I don't think that the Fed is going to just, totally go on pause because of that. The data is the data, whether it comes out or not. I think, though, that really is the key risk is what does the Fed react if we don't have the data. But overall, I would say the market is in a very strong place. I think with the policy risk side, it's really taken policy risks in stride post-Liberation Day. That was the peak for fear for corporates. That was the peak for fear for investors. So even with this government shutdown, if it's a matter of weeks, not a matter of months, I think the market will be able to take it in stride.
Is it a sort of contradiction in terms for the Fed to be cutting in the face of these robust earnings and what we're seeing in markets?
So the Fed is reacting to the labor market data. The Fed is not reacting to the earnings data. So I think if you're an equity investor, what you care about is, of course, the earnings, and you also want an accommodative Fed that's able to lower rates, able to spur growth. The Fed, though, they're not particularly paying attention to the earnings data to make their decisions. Of course, they look at it, but that's not what their mandate is about.
At the same time, in the past, asset bubbles and extreme valuations in asset markets has been something that the Fed has paid attention to. At what point does it matter? This is something that John was asking a couple of days ago. Does it feel like they're concerned about not addressing the fundamental problem in the labor market as much as they are inflating an asset price bubble and potentially inflation?
No, I really don't think that we're currently in a bubble state. I assume you're referring to AI with that bubble question.
Maybe.
And I want to unpack a couple different things. I would call it more of a boom than a bubble, a different B word there. But there's kind of three different prongs to the AI story. There's the underlying technology itself, which we're very, very bullish on. There are the AI enablers. They're the ones laying the ground, building the infrastructure to allow this technology to exist. Yes, valuations are very rich there. There's no two ways about that. It's a tough time to justify adding risk, but we do think the demand for compute is there. And then there's the AI adopters side of the story and what companies are going to be able to do with this new technology. As you were mentioning before around earnings, we think that over the next 2-year period, that's where you're really going to start to see some of those efficiency gains, some of those benefits from AI adoption.
You think it's a boom? At some point, does it bust?
I would not say a bust. Maybe you get some correction valuations, maybe you get a modest reset, but I don't think that, it's 2000. I think that's the comparison that everyone has been trying to make. And okay, great, is this just the dot-com bubble all over again? I would not say that that's on the table.
When you say you think that we're finally going to see earnings strength from AI, where exactly? Like outside NVIDIA, actually downstream companies that are supporting this industry?
Yes, so I would say more companies are now putting AI products live into production. We had the ChatGPT moment in 2022 when it sort of burst onto the scene, became a part of everyone's consciousness. There was a lot of excitement around it, but there wasn't a lot of actual corporate adoption yet. Our tech team runs a great CIO survey, and they estimate that around 60% of companies are going to have some sort of AI product in production by the end of this year. So now we're starting to move past the testing phase into the actual use case phase. And I think what's really exciting for investors around the AI adoption story is that it's not just one industry, it's not just one sector. A lot of the enabler story has been so concentrated, but this is really about technology diffusion. This is about different types of companies being able to adopt this, being able to increase their operational efficiency and improve some of their cost structure. So this is really a broader story.
Can we lean on your framework for Morgan Stanley for how you think about the equity market more broadly? This rolling recovery versus rolling recession. This is something you and the team have done for a number of years. I think back to the work coming out of the pandemic, it was a similar theme. Where are we in that process now?
Yes, yeah. So we think we're now exiting a rolling recession and in the early innings of a rolling recovery. What do I mean by rolling recession? So we, of course, haven't had a traditional economic recession. We have seen overall equity market earnings hold up. But if you look under the surface, if you're not just thinking about what's going on at the index level for earnings, you've seen the average stock in the market have negative earnings for much of the last 3 years. And it's really been happening in different phases. It's been rolling. So post-pandemic, you had a lot of weakness in the consumer goods areas, in the consumer tech areas, things that were really overconsumed during the pandemic. Then you had it kind of hit housing, then it hit manufacturing. So it's been happening in stages, which is why you haven't had that big index level earnings drawdown. But for the average company in the market, it's been a much tougher setup. We think now you're transitioning, though, into a rolling recovery phase that bottomed post-Liberation Day. You've had a really sharp V-shaped recovery in earnings revisions breadth. So analysts broadly are becoming more constructive on the earnings picture within the market. And we think that that is a pretty good sign that we're now entering that recovery phase.
I had a bunch of teens at my dinner table last night, and they were debating. I know that's explains a lot. Well, it explains why I make sound effects this morning. I'm just wondering whether they were going to get jobs. That's what they were debating. Can this be a jobless recovery? You start talking about the earnings breadth widening out. A lot of these smaller companies are adopting AI, algorithmic learning, making it difficult for some of these kids when they graduate from college to possibly get jobs. Is that possible?
It's largely been a low hire, low fire market on the labor side. But to your point specifically around AI, I think you're starting to see the impacts of AI on select pockets of the labor market. I want to be really clear. We are not calling for mass job loss due to AI. But when you look at things that are highly automatable from the AI adoption front, so particularly computer programming and customer service roles, so for example, you just type into a chatbot instead of speaking live with a customer service rep, you're starting to see an impact on the hiring for those jobs. For 22 to 25-year-olds in those industries, you've seen a decline in the number of roles, whereas it's broadened out for those who are older within those job roles.
Michelle, this was great. It's good to see you. Thanks for dropping by.
Thank you.
Appreciate your time. Thank you very much. Michelle Weaver there of Morgan Stanley on a rolling recovery that they're starting to see.
They all want to be plumbers, the teens, because that's
Is
where they
that
see
what
the
they're
money.
telling you?
Well, I mean, they all want to go into finance, but
It's
it's
a story
just
like 20 plus years ago in the UK. It was the same thing. We didn't have enough plumbers.
Well-
Then everyone went to what? To college to become a plumber.
yeah. Well,
And then we had too many plumbers.
Well, we don't have that yet. So the plumbers still are earning a lot of money. So people are actually looking at plumbing. But this is the point, actually. The sort of trade occupations are the ones that actually are the profitable ones right now versus, say, white collar, unless you're at the very top. And how do you get in if the entry level jobs? This was the discussion last night.
Still, the humanoids start to do that work too.
You think so?
Maybe. Who knows?
Think the humanoid?
I've got absolutely
I'm here
no
to fix
idea.
your toilet.
I don't know what's wrong with you this morning. Where are these impersonations coming from?
I had teenagers at my table last night. What
And
do
they
you
were
think?
doing robot impressions?
No, that's younger.
They need to work on their impressions,
Right.
so then you come in with better impressions.
What's in the coffee this morning? TK special?
Yeah.
That was going on here. All right, let's get you an
Let's
update
move on.
stories elsewhere this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you so much. The US government shutting down then after a midnight funding deadline passed without an agreement on a funding bill. Democrats refused to sign on unless the bill included healthcare spending. President Donald Trump blamed, quote, crazed Democrats. The shutdown will disrupt hundreds of thousands of jobs, upend many public services, and lead to delays in key economic data. Pfizer won a reprieve from President Trump's threatened tariffs on Big Pharma. The company agreed to slash some of its drug prices by up to 85% and sell directly to the American public. Pfizer said it will make sure Americans receive comparable prices to those offered in other countries. Other drug makers are expected to make similar agreements. Nike reporting first quarter sales and profit that beat expectations as its turnaround efforts started to pay off. CEO Elliott Hill has pushed to reset the athletic apparel maker by clearing out old inventory and reorganizing the corporate structure, including replacing many top executives. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, entering a government shutdown.
Republicans are plunging America into a shutdown.
We're doing well as a country, so the last thing we want to do is shut it down. But a lot of good can come down from shutdowns.
Up next, George Pollack of Signum Global, live from New York City this morning. Good morning. "60 minutes away from the ADP report, taking on additional significance this week, given the fact we might not get payrolls on Friday. The estimate, the median in our survey, we do a survey for this. The median is 51K, the high is 80, the low is 25.
Look, we're kind of poking fun because it used to be who trades off the ADP report. And then it became maybe the ADP report is actually more accurate than non-farm payrolls. And now it's we only get the ADP report, so you better trade off of it. And that's where we are.
It's fairly decent data.
It is.
You'd call it second or third tier economic data. I get that. But for a good reason. Vonnie was talking about this earlier this morning, the way UBS sees this moment, that it's like looking through the keyhole with the alternative data. It's clear, but it's narrow. You're not getting that broad look at the bigger economy.
If ADP doesn't necessarily look at government jobs, they look at private payrolls so they can get a good read on some of the industries, some of the sectors. Looking through a keyhole is a really good way of putting it. But people are going to be looking through every keyhole they possibly can find without anything more broad.
We'll cover it extensively at 8:15 Eastern Time. The market will too. Equity futures right now in the S&P, negative by 0.5 on the Nasdaq 100, also down by 0.5%. The equity market a little bit softer this morning, following some major gains for Q3 and the month of September. For Q3, the S&P 500 up almost 8%. The Russell up by around 12%.
And this comes with the idea that the Fed is going to be cutting rates, and not just what we saw last month, but there will be consecutive moves, including at the end of this month. That's the rub. What happens if you get more Fed officials coming out like Lori Logan, like Austin Goolsbee, like some of the others who say we don't want to front load this stuff? This is actually a concern to us given the fact that inflation is still real. All of a sudden, do you have a risk to some of those trades, or is this, money printer go, whatever?
Is Goolsbee starting to sound a little bit political?
He's been, yes.
Yeah?
I mean,
do you think he gets the same kind of opportunity that Governor Myron does, or rather lack thereof? at the moment to voice his opinion on things. It's kind of odd to see Goolsbee have a certain view on things right now compared to where he was 12 months ago, depending on who's in the White House at any given time.
I think that there are two Fed members that I could say this about. I think that probably Austin Goolsbee is one of them and Mickey Bowman is the other, who's made a complete flip-flop depending on who's in the White House. And so you can see that in pretty cold relief. So to say that the Fed has never been politicized or that economics doesn't have a political bent to it is probably incorrect. The question is the battle of the viewpoints and the ideologies coming together with a lot of people who are just trying to parse the data and everyone just trying to do the right thing. And I think that that's the mess in the Federal Reserve.
It's an interesting way of framing things. We'll try and pass the data later on this morning. Under surveillance this morning, entering a government shutdown.
Republicans are plunging America into a shutdown, rejecting bipartisan talks, pushing a partisan bill, and risking America's health care.
We're doing well as a country, so the last thing we want to do is shut it down. But a lot of good can come down from shutdowns. We can get rid of a lot of things that we didn't want.
It's the latest this morning. Congress blowing past the midnight funding deadline, pushing the U.S. government into a shutdown, the third under President Donald Trump. Bloomberg's Laura Davison joins us now for more. Laura, I just want to pick up on that language again from the President of the United States. A lot of good can come from shutdowns. What kind of good can come from this?
Trump has floated a lot of ideas that Republicans could use this shutdown to their advantage. They could enact large layoffs of federal workers. He talked about cutting spending of programs that Democrats like. Trump and the White House have wide latitude to do a lot of things during a shutdown. Some of these things, like we saw with DOJ, might not totally stand up to the law, but you do them. And then, when the courts are shut down, they move a little bit slower and you don't actually litigate those things for several weeks. The question here, and that both sides are weighing very carefully, is who is going to win the messaging war? That is the risk that both sides have, this could dog them in the midterms. Democrats are hoping that as soon as some of these notices start going out to people who are on the healthcare exchanges, that their premiums are going to rise, that the public will come to their side. That is a little bit of a gambit because the public does not like shutdowns. And right now, people view the Democrats as being the one who are sort of pushing the shutdown. This is a different position for them. Generally, it's the Republicans who found themselves with the blame.
The blame game will continue through today and maybe into the weekend. Laura, thank you. To extend the conversation, joining us now is George Pollack of Signum Global. George, welcome to the programme. Let's play the blame game. Who's winning right now? Who's winning in the court of public opinion?
I think for right now, it has to be considered that the Republicans are winning in the court of opinion. They get the headline. Republicans funded government. Democrats said no. And I think that's a difficult headline to defeat. And Democrats are still continuing to be disjointed in their messaging. We've seen talks about healthcare. We've seen talks about rescissions. We've seen talks about congressional power of the purse. And we've seen talks about immigration. So it's kind of been disjointed from the Democrats.
How long do you think it's going to last, George?
I think right now our view is that this will last around 5 to 10 days. Because the reality is Democrats don't like shutdowns. While they are coming into this shutdown because they fear their base, that fear only takes them so far. And as we already saw with Cortez Masto and Angus King voting for the GOP funding bill, this isn't a thing where it's going to be a long-term shutdown.
When the president says we can do a lot, get rid of a lot of things, is he talking about getting rid of institutions, individuals that are going to be furloughed permanently? Is he talking about permanent changes?
So it seems what he's trying to say is, look, once we furlough these employees, it's going to be politically easier for us to actually operate reduction in forces and remove them. The issue is the civil service protections still exist. So they're going to still have to go through a notice period. They're going to still have to go through an administrative period. And it's not going to be right away. And as your reporter was saying, it's going to be subject to additional legal challenges.
George, are you expecting travel disruptions? And I say this with the TSA agents that are considered critical workers, but last time around just walked off the job or called in sick because they weren't getting paid.
Well, that's the big question. And I think what the TSA agents and similar people in that positions have learned is we do have power. So last time was 35 days when they started to do the walk off the job. I think this time we should expect that if it gets that far to be triggered much, much earlier and for them to be unwilling to really portend a long shutdown.
George, you said the Democrats are catering to their base. Who is the Democratic base right now?
I think the Democratic base is generally people who are frustrated with the president, who are concerned that Democrats were saying he's going to govern like a dictator, he's going to govern like a fascist during the campaign in 2020. And by and large, to the president's credit, he's governed as he campaigned. And for these people, they can't understand why Democrats are treating him so normally. For example, when the administration recently deployed some troops, Hakeem Jeffries made the comment, well, you can either focus on that or you can focus on doing health care with us. And for the Democratic base, they're saying, but wait, he's deploying troops to American cities. Why are you so focused on such relatively minute issues like healthcare?
George, with that in mind, where's the leadership going to come from going into the midterms, one, and going into the next general, which is something they've got to think about already?
I think that's the biggest question. And the issue is Chuck Schumer, Hakeem Jeffries, while they serve as leaders in the Congress, they don't have much buy-in with the base. When they speak, I think the base feels that they're largely ignoring them and they're not the vocal advocates they want. Right now, the man who's probably the most effective leader of the Democratic Party, and I can't say politically good or bad, is Gavin Newsom, because he's actually implementing a fight back and arguing that we can't continue to treat this as normal.
So, George, are you saying when it comes to Democratic leadership, it all needs to come from outside the bubble of Washington, D.C.?
I think that's where we're going to see it being mostly come from, because the reality is Jeffries and Schumer have put themselves in a position, be it in March 2025 or with their messaging since March 2025 in the last funding bill, that they feel that the base believes them to be out of sorts with their priorities. And Gavin Newsom, with his Twitter profile, with his policies, with his executive action, seems to be the one truly leading a substantive pushback against the president.
And his hair and his Hollywood smile and all of that, George, of
podcast.
Course. You know, if he wasn't good looking, would we pay this much attention to him?
Isn't that an evergreen statement about everything in life? I mean, honestly, at a certain point, to be a politician now, you kind of have to work social media and be something of a pop star one way or another.
All of that, but isn't California like the poster child for all the things that Republicans have beat them on in the last general?
This is the reason why some people are wondering whether this is viable. They're looking at Gretchen Whitmer, they're looking at other places, but ultimately it comes down to what George was talking about there, this idea of the base being people who are opposed to the president. That's a pretty disparate base with a lot of different agenda items, and who's going to bring them together and then face that withering criticism that you were talking about?
I'm not jealous of the hair. Maybe a bit. George, thank you. George Pollack of Signum Global.
Tell us more, John.
Thank you so much.
You really?
Just having a conversation with myself. I actually wanted to get to this. Torsten Slok of Apollo this morning. What a note from him. We in the economics profession need to look ourselves in the mirror. Goes on to say the consensus has been wrong since January. The forecast for the past 9 months has been the US economy would slow down. The reality is that simply has not happened. The US economy remains remarkably resilient. Bottom line, is becoming increasingly difficult to argue that we are still waiting for the delayed negative effects of something that happened 6 months ago, Liberation Day. For investors, this means that the upside risks to inflation are growing, particularly if the Fed continues to cut interest rates.
This is what Max Kettner was talking about, that this may be a policy mistake if the Fed cuts rates, but that doesn't matter if you're an investor. You get long because ultimately they are underwriting risk. This is essentially what Torsten's been arguing, though, all year. So in one level, yes, it's sort of saying economists have gotten this wrong, but then he's arguing that they've been getting it right, and for the most part, they have.
I feel like I'm having deja vu to June when Torsten put out a note about how Trump has outsmarted everyone when it comes to tariffs. And this is another note that might land in the inboxes of individuals working at the NEC, and you're going to hear Caroline Leavitt talk about it at the podium, I'm sure.
Without a doubt. I imagine that could happen in the next few days. Coming up on the programme, we'll catch up with the former White House trade official Kate Kalutkiewicz with steep new tariffs in effect. Plus, Yahara has your morning movers. Nike shares rising on the back of their latest earnings report. That stock is up by 3.9%. And in London, happening right now, Bloomberg's Women, Money and Power event is underway. The editor-in-chief of The Economist among today's guests. Bloomberg subscribers can watch on Live Go on the Bloomberg terminal. Live from New York City, you're watching Bloomberg TV. Stocks are softer. We're down by 0.5% on the S&P. We're down on the Nasdaq too. We've been up and away through Q3 and through September. What a move we saw in the third quarter, particularly through September for the stock market. Through Q3, the S&P up by almost 8%, the Nasdaq up by close to 9%, the Russell up by 12%, and so much of that move for the Russell came in the month of August when we had this massive repricing of interest rates, particularly at the front end. That was true in the bond market too. Two-year bond yields down for the third quarter, down for 3 consecutive quarters. But that move really came through August. Through September, that started to stabilise around 360. And that's because this big debate is coming together with the Federal Reserve. In early August, you're sitting there thinking, OK, really weak jobs report. Fed's got to move. Here we are in early October thinking, OK, how many more times has the Fed got to move? Governor Myron wants to go down maybe another 100 basis points. I can point to 1, 2, 3 people on the committee that are struggling to get to 1 or 2. for the next 6 months.
In August, it was obvious. You had non-farm payrolls that spooked everybody. You had revisions that just added to that. Then you had a Fed that said, OK, we're throwing in the towel. We're going to be cutting rates of Jackson Hole. And then all of a sudden, the data starts getting a lot better. And this looks like a lot like what we saw last year around the same time, the head fake over the summer. And Fed officials are reflecting that, and they're reflecting the changes. They are only as good as the rest of us, and they only see what the rest of us see.
And that's where the market's living, in this wonderful place called 2026, where growth is better and profits are healthy and the AI boom continues. Think about the September we've just had for credit, for equities, for deal making, for the biggest leverage buyout ever. And the Federal Reserve came out and said, don't care about that. I'm worried about this. I'm cutting interest rates. And that's what's making the bulls right now so bullish into year end.
Especially because ultimately you can make an economic case for it. If the Fed is watching the labor market isn't really doing much. I mean, what we saw yesterday from JOLTS data, which really is probably the last economic data that we're going to get from the government, it's kind of the stagnant market. So you could say, OK, maybe it needs it. Do we get a jobless recovery in the market profits, even with maybe the rest of the economy still lagging behind?
Low confidence consumer, high confidence investor. And that dichotomy has persisted over the last several months and may well continue to do so into next year. Equity futures right now in the S&P 500 negative by 0.4%. Let's get you some morning movers. Here's Yahira with more. Hey, Yahira.
Hi, John. We start with a big mover. Lithium Americas soaring 33% in the pre-market after Energy Secretary Chris Wright confirmed on our network that the U.S. is taking a 5% stake in this company and a 5% stake in its Nevada mining project, home to the largest lithium deposit in the U.S. It marks the latest example, of course, of the Trump administration making investments in critical areas of the economy. And moving on to Nike, whose comeback bid is gaining traction. Shares are up 4% after sales came in surprisingly better than expected, but there are still hurdles, with the company saying that it expects to take a hit of $1.5 billion this year due to tariffs. That is more than the $1 billion it previously projected. And we end on Delta. It is rising nearly 1% in the pre-market after Jefferies upgraded the airline to a buy, with the analyst Sheila Kahyaoglu saying that stronger third quarter revenue guidance gives her confidence that margins will expand. Her new price target is $70, about a 22% upside from here. John?
Yahira, thank you. Appreciate it. Bramo, you talk to the airlines. They're living in a similar world to the markets, it seems. Looking forward to about a few months ahead for economic activity.
It's a world in which Delta and United do very well because they cater to the upper income consumer as well as the business class. It's a world in which Frontier and Spirit are going to continue to struggle. And this is the dichotomy that we see in the economy. And this is the dichotomy that we see in the airlines.
Delta is so popular right now. I was looking at a Delta flight the other day. I won't tell you the route.
I know what you're
so
looking
American
at.
now.
Yeah.
Okay. I
Yeah.
won't tell you
Transatlantic.
It's fine. Okay.
the route.
Yes.
Okay. I'll get through this moment.
I hope so.
It was so expensive.
Yeah.
And it was months away.
That's exactly what I complained about to the United CEO. I said, listen, Scott, it's so expensive. If you want to go anywhere in December, we're driving. And he's like, well, tough. This is what happens. Don't go to such popular places or take time off another time.
I would tell that to management.
Yeah.
It was a work trip.
Yeah, exactly.
So I'll inform them. Yeah.
Oh,
I will
please do.
inform them. All
I'll
right.
go another time.
Maybe next year, the year after. On our radar this morning, a partisan impasse over spending and healthcare triggering a government shutdown. The shutdown potentially spiking the unemployment rate and delaying key economic data. Elsewhere, Lithium Americas rising as the US agrees to take a 5% stake in the company and a 5% stake in its Nevada mining project. The move aiming to speed up development of a domestic supply chain to counter China's dominance over rare earths. That stock is absolutely surging. Elsewhere, the US Trade Representative Jamieson Greer saying he expects President Donald Trump to sign more trade deals with countries in Southeast Asia during a trip later this year. Several nations still negotiating lower tariff rates.
So here's my question when it comes to what U.S. Trade Representative Jamieson Greer was talking about. Are these the frameworks this administration has gotten with Japan, South Korea, and then they want to actually nail some of the final details, sign them, and have these big ceremonies? Or is he talking about other deals? Basically, maybe a bigger trade deal with China, because the president already said he's going to be seeing Xi Jinping on the sidelines of the APEC summit. So I think there's a lot to take from this one statement. What exactly are we getting from this trip? Is this just a sign on the dotted line from those frameworks? Or are we going to get something substantial when it comes to the two biggest economies in the world?
We've talked about this before. Now, typically, any statesman, any leader, head of state would go into a meeting with 99% of the work already done, and then you go and sign a deal. That doesn't seem to be the way President Donald Trump approaches this kind of thing. It seems to be deal making in the moment, which raises a lot of questions about this moment. If you think about the objectives they'd like to achieve with other nations' economies in Southeast Asia, you'd imagine it would sound like this. OK, we'll sort out a nice tariff deal for everybody, but what we'd like is for you to do something about the transshipping, the goods coming from China into the rest of the world. At the same time, you're going to come to an agreement with China on everything else. I'm not sure how you can do one and achieve the other.
Nothing exemplifies that more than Taiwan. And you mentioned this earlier, the idea that Taiwan is coming out and saying we didn't agree to what the U.S. is saying, which is that 50% of the production comes from the U.S. And this goes to the question of how much will Taiwan be a bargaining chip in that grand détente between the U.S. and China, at the same time that Taiwan is instrumental in a key component in everything that we use every day here in the United States. This highlights the complexity of a simple transactional type of relationship that we've been trying to parse out without really a greater framework.
Let's stay on the trade story. The president's steep tariffs on pharmaceuticals, heavy trucks and furniture going into effect today. Joining us now, the former White House trade official, Kate Kalutkiewicz. Kate, welcome back to the programme. Let's think about this meeting, series of meetings that take place in Asia over the next month or so. How are you thinking about what can be achieved on that trip?
Well, when I listen to the predictions of Ambassador Greer, the U.S. trade representative, I think I have to go on the side of these are deals with other Asian economies, probably not China. And I think if you remember back to Liberation Day, some of the highest tariffs were handed out to economies in Asia. And I think those countries, particularly the ones that have not gotten framework agreements yet, are still very anxious to hammer out some sort of deal.
Kate, does the U.S. need to present some sort of larger framework for its relationship with China as part of these trade deals with, in particular, Southeast Asia?
Well, it's an interesting question. I mean, I think what we've seen, of course, is the agreements the Trump administration has struck so far have included provisions directed at China. So some sort of framework, a global framework, if you will, around shared objectives toward China, higher tariffs, provisions that try to cut down on transshipment, economic security. This is the language they use when encouraging trading partners to adopt similar measures to China. Now, what that means for the bilateral with China remains a bit, unseen.
At this point, though, Kate, do you get some sort of cohesive sense of the relationship that the U.S. wants both with China as well as with Southeast Asia, which makes a lot of goods for the United States and is, frankly, the basis of a lot of the fast fashion and other retail brands in particular?
Well, the reality for most of those economies, of course, is that the United States wants us to buy less from those economies. So fast fashion, furniture, we saw some moves this week on furniture. This is very impactful for that region. The president has been very clear about what he wants, and that is more production in the United States. So I think these agreements around the edges will be on items we can't make here. Critical minerals will be a focus, of course, with Taiwan trying to incentivize more moves on semiconductors. The question about what he wants with China, I think, remains really questionable. We don't know. He wants a deal with China, of course, but another comment that Ambassador Greer made yesterday seemed to signal, a bit of a heightened posture, a threat that tariffs could go back up after November 10th if we don't continue to make progress. So I don't know that we're getting closer to a bilateral deal with China.
So what's going to come out of this meeting between President Trump and Xi Jinping? Because Trump says they're meeting.
Yeah. Well, look, a meeting is not, they're not going to want to have that meeting result in heightened postures that take us away from a deal in the future. President Trump has been very clear. He wants a deal with China. So I think that both sides will find a way to maintain the status quo. Both sides, though, frankly, have been increasing pressure. The Chinese themselves this week added new provisions that will impact goods going to America. The United States added lists that impact the way we sanction and address foreign companies buying from China. So they're adding, this is what we've seen, I think. They add leverage and then they potentially negotiate that leverage away to keep the status quo.
It's a great point. With all the tariffs coming out, a lot was missed in terms of the U.S. expanding the export blacklist, the entity list when it comes to China. So do you expect more moves things like that before Trump sits down with Xi?
Well, I think this is this repeat that we have found ourselves in this relationship. Until and unless we can articulate a grand vision for the trade relationship between the United States and China, I think we are going to create these false pieces of leverage that can then be negotiated back. So these are important moves that are being made. The United States as well in a few weeks will implement new tariff fees on ships from China. This will be very dramatic. So these are all new things that can be negotiated in advance of a November 10th deal while we retain everything else that's on the table.
Kate, just to give this more context, is that what you think the H20 chip reversal was about, getting leverage to then just unwind it?
Well, I have to imagine that was part of it because the Chinese made, a seemingly big deal about getting access to that chip. They got access to the chip and then they turned around and said, we don't want it. And by the way, we're going to take action against NVIDIA. It all seemed sort of a false construct to me. So perhaps that was their intention all along.
Kate, appreciate your view, as always. Kate Kalutkiewicz there, the former White House trade official, on what we could see over the next month. When's this meeting?
End of October, early November, yeah.
What do you think we can achieve?
Well, this is the problem. I think the Chinese delegation want to go in knowing exactly what's going to come out of it. To your point, 99% of the deal done, and then at the presidential level, you just sign off. Trump is happy, I think, to have basically the start of the negotiation almost in person, but then he did say he would go to China next year. So potentially this is going to be a two-part scenario. He sees what they come out with something, maybe soybeans. I think right now that is critical to his base in rural America. And then the bigger grand bargain potentially happens next year.
You've said this a number of times. When this kicked off in the middle of 2018, this took 18 months to sort out before we secured these purchase agreements going into the pandemic. Pandemic hit, everyone forgot about them, but it took 18 months.
And that was just purchasing agreements. Now it's everything. Export controls, TikTok, purchasing agreements, rare earths. This is going to be incredibly difficult. Fentanyl, are they doing enough on fentanyl? If not, those tariffs are staying.
This is a super heavy lift for the administration to address, and it's a big, big issue that's been building for a long, long time. Equity futures on the S&P negative here by 0.4%. With an update on stories worldwide with your Bloomberg brief, it's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Taiwan pushing back on a U.S. request to move chip production stateside to cover half of America's demand. Taiwan's vice premier says the country never made a commitment to have the U.S. produce 50% of the semiconductors it needs. U.S. Commerce Secretary Howard Lutnick said the U.S. has held discussions with Taipei about the proposal as a way to reduce the risks of over-reliance on overseas chip making. The FTC blocking a partnership between Zillow and Redfin. The deal would have made Zillow the exclusive information provider on rentals offered by Redfin. The FTC said the partnership would cut the number of websites offering apartment listings, leaving consumers with fewer choices and driving up prices for buildings that want to advertise. In sports, the MLB postseason is underway. The Detroit Tigers and Boston Red Sox are off to a strong start in the wildcard round after each winning Game 1 on the road. In the National League, the home teams fared better, with the Chicago Cubs beating the San Diego Padres and the LA Dodgers beating the Cincinnati Reds with 2 home runs from superstar Shohei Ohtani. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Anything to add, Bramo?
Yeah, just want to point out that the Red Sox are moving on and, against somebody else. Just saying. I mean, look, honestly, I'm pro New York because here I am. At the same time,
Here I am. Thanks, Lisa.
Anytime.
Did Bramo just get the eyes?
Yeah.
Did Bramo just get the eyes?
Yeah, it was a rough night. I was feeling so optimistic when I first put the game on, and then
got the beat out for you.
Okay. All right. Should we move on? You done? You playing the violin for her? All right.
Yeah. Big violin.
Up next on the program, passing on higher prices.
Our members are eventually going to pass on the price increases to our consumers, and that's starting. We're seeing that in earnest, and our consumers, 75% of which in a recent survey that we conducted said we're seeing those price increases in footwear in particular.
That conversation up next with Adrienne Yih of Barclays. Live from New York City, welcome to the program. Under surveillance this morning, passing on higher prices.
Now that those reciprocal tariffs have hit and are in place, it's inevitable. Our members are eventually going to pass on the price increases to our consumers, and that's starting. We're seeing that in earnest, and our consumers, 75% of which in a recent survey that we conducted said we're seeing those price increases in footwear in particular. We'll have to see how much price flexibility or elasticity our members have in response to what consumers are saying they need to make a purchase.
So here's the latest this morning. Nike's turnaround efforts taking shape with better than expected sales. Tariffs weighing on the company's comeback somewhat as it raises some consumer prices. Adrienne Yih of Barclays raising her price target on Nike to 70. Adrienne joins us now for more. Adrienne, welcome to the program. Always good to catch up. Let's just talk about Elliott Hill and what he's doing and the kind of turnaround that he's already delivering. How effective is it? I was thinking about inventories and how aggressive he's been on that front too. Are you starting to see some real results?
Inventories are the beginning of any turnaround, right? It stabilizes the margins. And so what I would say here is there are typically 3 years in kind of a branded recovery. The first year is basically the reset year, which was FY25, where he came in and he cleaned up the marketplace and he cleaned up the inventory and created innovation, right? An innovation pipeline that we're starting to see right now bear fruit. The year 2, which is what we are in right now, is typically the year of inventory cleansing and finding a firm kind of terra firma on margins. And then year 3 is profitable growth, and we're expecting that to come in FY27. So we are clinically going through the classic steps of the turnaround. And I would say the key data point that you should be looking at coming out of this print, not just the beat on the quarter, we know they ended up lowering the out quarter, but it's really that sales to inventory growth inflection. For the first time in many quarters, we're seeing sales grow at 1% and inventory down about 2%, low single digit. So we like that positive spread. It's a harbinger of margin stabilization to come over the next couple of quarters.
So that's the year 1, year 2 story. I think we should sit on year 3. Adrienne, what's the secret sauce? Are there reasons to be hopeful?
There are reasons to be hopeful. As we know, they've taken about 30% of these big 3 classics, the Air Force One, the Air Jordan 1, and the Dunk. They still have work to do on the Dunk, meaning that they want to bring that exposure, how much is in the marketplace, down. They really want to move toward a pull model. So you're never going to see those 3 classics take so much of their, sales volume. And what they're doing is they're replenishing the pipeline, starting with performance. So starting in Run, Vomero 18, Pegasus, and Structure. And then as we're going into next year, you're going to start to see a lot more of what they call sportswear, which was previously named lifestyle, right? But they're calling it sportswear. It's the non-performance side of it. That product is going to start to flow in probably more so in calendar 26 and then into the back half of next year. So definitely some hope on the product.
So essentially, the cool stuff that people can resell on some of those sneaker platforms isn't going to come until 2026, 2027. They're now going to focus on actual sportswear and competing with the likes of On Brands or On Holdings or other potential running brands, Hoka, that have really gained steam. Is that right?
Yeah, the On Running and Hoka, together are almost $5 billion of the performance run category. And they weren't there previously, like in the, 5-10 years ago, right? It was Nike dominating that performance run. So they're coming back to kind of the win now strategy, which is really focused in athletics and athletic endeavors. And then from there, when they rebase and kind of get back that brand equity, Nike is about winning and is about sports, then they'll take that and then halo that on to kind of the more sportswear or the lifestyle, what I like to call lifestyle type product. But they're starting to bring that to market. And you're definitely going to see the infill. Remember last year in February, they'd started to pull all that. Actually, now they'd started to pull all that product out of the marketplace, and you'll see some incremental infill. Now, when you take a big chunk out and you put kind of newness in, there's always the demand uncertainty of, is it the right stuff? And we're doing that in a tough macro environment.
When you talk about the macro, Elliott Hill said that challenges remain, particularly when it comes to places like the Greater China region. Can Nike continue to recover with China as a part of their business, or do they need to make a decision whether they're in or whether they're out?
Yeah, China kind of pre-pandemic was sort of in the mid-teen range. It was supposed to have grown over that horizon, right, to about a quarter of the business. Today, it's about 12 or 13% of the business. So it's actually shrunk, and the profitability has shrunk along with it. I would say that a fully expressed turnaround of Nike cannot be done without its growth regions, and China is the growth region, along with APLA. Which was also, Asia Pacific, Latin America, which was also under some stress. So those two regions, they talk about being staged. Traffic got worse in China. And so they're kind of what I call chasing the ball downhill. You think you're someplace, you go to it, and it goes a little bit further down. But I do think that as you get kind of the global, particularly North America, stabilized, you'll create some of that global brand heat. And the other two will come along eventually, particularly as they're doing this inventory purging.
When it comes to Nike, 16% of their manufacturing is in China. Can they get that below 10% at some point?
So there's two reasons, really, maybe three reasons why you're going to be in China. Number one is volume. So you'll see the bigger manufacturers having a tougher time sort of getting out of that China region. Number two, you do it for quality, right? So if you higher quality control. And then number three, you would do it if you have a lot of kids business, just because of that you want to make sure that you have that kind of all the regulatory environment. So what I would say for them is they can get there. Probably they can make a lot of headway on their footwear, which is primarily done in Vietnam. And then they can probably get that to a low double-digit number. I'm not sure that you ever, for them being that large, that they ever can get the economies of scale that they do in the China region as they move to smaller markets with less kind of infrastructure for somebody as big as Nike. Smaller players can definitely do it. Big players, $46 billion footprint type players, harder to do.
Adrienne, you're one of the best, always a clinic. Always walk away from these conversations with a clearer picture of things. Thanks for being with us. Adrienne Yih there of Barclays on Nike this morning. Year 1, year 2, year 3. We're in year 2. You talked about Hoka and On Brands. They were getting killed by them, and they're fighting back.
Yeah, they're saying, look, we're not just a shoe to wear to school and then resell when you don't decide to walk normally for a while. But I do think now that they're focused more on running, the question is how big is this market? How much can they gain territory? And how much does their model depend on imports from Southeast Asia in particular?
I can't believe people do that.
They do.
They're like getting the Nikes and trying not to walk properly because they don't want to crease them.
Yeah.
You had this at home?
I did have this at home. And I was
goodness.
I was like, listen, it's not worth it. And then, just the walking
just
like an avatar.
It's like wearing platforms.
Maybe just get shoes that you can wear.
I agree. Anyway.
Personal.
Anyway. Coming up, Yoder of JPMorgan, Greg Daco of EY, Tiffany Wilding of Pimco, and Vivek Arya of Bank of America Securities.
Both parties want their little demonstration. My instinct is this probably goes on for about a week.
Refusing to release the BLS data is going to be a problem for the markets.
Probably this report is not coming out on Friday.
If we still have a shutdown, it could impact the Fed meeting, and that might be reason for people to pull back.
Even with the long shutdowns, you still have markets outperforming.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 negative this morning. Down across the board, we're off by 1/3% on the S&P. On the Nasdaq, we're down by 0.4 after delivering a monster Q3 for the S&P, for the Nasdaq, the Russell. Over the previous 3 months, up around 12%. In the bond market, 2-year, 10-year, 30-year bond yields look like this. Your 2-year down by 1 basis point, your 10-year down by 2, 413.48. Heading into this mess. No jobless claims, no payrolls. In about 14 minutes' time, the headline data point of the week, ADP employment.
I was going to say, heading into this, the moment of the week coming up in now less than 14 minutes, which is the ADP report, the expectation for 51,000 jobs coming down from 54,000 the previous month. This is what we're going to be really amping up, and potentially the market will really be responding to, because this and then ISM manufacturing that we get later this morning might be the last read that we get for quite a while in our keyhole of economic data. that is getting narrower because of perhaps the government shutdown?
ADP Wednesday doesn't quite have the same ring to it, does it?
Let's we get to take off Thursday and Friday now? Because, usually it's jobs and then weekend.
No reason for us to be here.
Why are we going to be here?
Take the long weekend.
Wait for the government to open, get the data. Exactly.
I feel like we're kind of essential. Let's run with that. All right, that's kind of important.
Okay. I'm taking off Friday.
Let's get paid at the end of the month. Coming up on the programme, super essential. Yoder of JPMorgan Private Bank as stocks pulled back from all-time highs. Greg Daco of EY as we break down the latest ADP employment numbers, and Tiffany Wilding of Pimco with future data in jeopardy following the government shutdown. We begin this hour with stocks pulling back following the strongest September in 15 years. Yoder of JPMorgan Private Bank writing, "We are still constructive on the market despite a strong year-to-date rally." Abby joins us now for more. Abby, good morning.
Good morning.
Is ADP the new NFP?
I mean, I guess so, right? This is quite unique, but I also think the market doesn't seem to really be paying attention to what's happening from, the government shutdown perspective. It's really focusing on the fact that the strength in both the economy and earnings this year have been underestimated, perennially, basically. Starting in April, it's just been a complete underestimation in terms of the strength, the ability for companies to be able to navigate through what is very turbulent, geopolitical scenarios. So I think, we'll get this last data point. Who knows how long this government shutdown will last? Historically, it doesn't have a huge effect on financial markets. GDP can maybe be affected, and then you see a bounce back. But right now, we just need to see how long this is actually going to be going on.
Torsten Slok of Apollo said something similar to you. We've underestimated the economy. He said the economics profession needs to look ourselves in the mirror. Concluded with this line, and I wonder if you agree with this too. This means that upside risks to inflation are growing, particularly if the Fed continues to cut rates. Do you share that view too?
We don't share that view. We don't see signs of, the services side of inflation, picking up, which is what would, be concerning to us, particularly on the wage front. I think it's very hard right now for economists to think about, what is there are all these different things that are happening at the same time, particularly on the immigration side, that I think make it just very difficult to kind of parse through the data and think about where we are from a break-even standpoint. But again, just thinking about it, we had, 2Q GDP come in, over 3%. We're having 3Q GDP looking in that direction as well. This economy can withstand some slowdown, right? It's on a very, very solid footing.
So why is it that the Fed could cut rates even though there's an incredibly solid footing in the economy and not see the inflation that Torsten Slok is talking about?
Because what's going on in the labor market, right? Because it's kind of this no hire, no fire labor market. So I think this is a unique position where the economy is growing, pretty healthily, and the labor market is kind of this odd one out where it's just got a lot of things happening that make it very difficult to understand where this, is it strong or is it, weaker at the margin? And what's causing that? Is it, the visa picture, right? Is it immigration, or is it AI? It's very hard to disentangle what's going on from a fundamental perspective. But right now, the economy's strong, profits are strong, but the labor market is kind of the one thing that stands out as being relatively weak, and that has implications for wages.
The longer that continues, how much does it make it difficult for you to argue in the broadening out? The idea, not necessarily in the other 493 and the S&P 500, but the Russell 2000 and some of the smaller companies that might be more susceptible to that dynamic in the labor market, considering that they're more leveraged to consumer spending and consumer appetites?
Yeah, well, I think what that will depend on, right? Because basically what you're getting at is what happens with margins, right? And small companies obviously have a lot less bandwidth in terms of the margin story. I think that'll be really, what will be important in that discussion is what happens with technology and what happens with AI. Is that being implemented and therefore offsetting what is a weaker labor market and adding to the productivity picture, right? I think that's going to be very interesting. And your point on small companies is interesting because when you look at a lot of the data and the surveys that have been done in terms of adoption from an enterprise standpoint, it's mostly on the large side, right? It's really not on the small side. So because of that dynamic where you're seeing, because they rely so much on the labor side and have those thinner margins, they should be probably more at the forefront of adopting, this technology, but they're not. So we're not of the camp right now that you see this broad widening out necessarily, particularly because you just need to see more reprieve on the interest rate side.
There's a large gap between your bear and bull case for mid-2026. What would it take to hit that bear case?
It would be a traditional recession. So the way we're thinking about that is that like average 25% drawdown from our, let's call our base case, right? So that would be where we're getting to that. And that would just be a market deterioration in the labor market beyond what we're expecting at the moment.
So beyond the basically stasis we're seeing. Mm-hmm. When you look at all the AI growth in the market, can you decipher any of this and how it's hitting the labor market, even though it's sky high on the equity markets?
Well, I mean, I think the argument is out there that it's affecting, the entry-level workers, right? And that's why you're seeing their unemployment rate move higher. I think, again, going back to this very muddied picture from the labor market perspective, I don't think that necessarily you're not seeing younger workers hired because of AI. It could have been the immigration surge, right? Like there was, the administration coming out with this H-1B visa policy, I think is trying to tackle that exactly, right? Like why do we have this youth unemployment rate moving higher and these large cap companies hiring so many people from outside the US? Why don't we focus more on the pool of talent that we have here? So I think that's something that's top of mind in terms of.
We're 2 weeks away from earnings season now. Banks are going to kick things off. What are you looking for? Starts with the banks, then we'll move on to other themes and other industries. But what are you looking for and how high is the bar for corporate America?
I mean, the bar isn't that high. Like we've had 3 consecutive quarters of double-digit earnings growth starting in, Q4, and expectations for Q3 are, 7 to 8%, so relatively low. And there's been a dichotomy, right? Like you've seen revisions for the full year move higher, but it's really being primarily driven by AI and the Mag 7, and the rest of the market is still seeing some weakness in terms of their revisions. So I think the bar isn't that high. It feels like a somewhat similar setup to 2Q in that we think, we're probably going to exit the quarter with another double-digit earnings growth picture. Just because, again, when we're thinking about the economic backdrop, this was like another quarter, just like 2Q, where everyone's saying we're going to see the effects of tariffs. It's going to come through, and it just hasn't happened, right? To Torsten's
I'm hearing
point.
it again.
Yeah.
I'm hearing it again from other banks. Citi, Nathan Sheet saying it's going to bite. Other economists are waiting for it to bite too. Are you saying it's not going to bite?
Not in 3Q. We're not seeing signs of it, really. And so I think again, going back to what we were talking about at the very onset, like the fact that companies have been able to mitigate and really work through this situation in this ever-changing scenario has been extremely impressive in terms of what we heard from 2Q. And I just don't see 3Q being any different.
Abby, it's good to see you.
You too.
Thanks for dropping by. Abby Yoder there of JPMorgan Private Bank. Got to go a little bit earlier to prepare for the big one. The jobs report dropping in about 6 minutes' time. The ADP report just around the corner.
I can't wait. I'm so excited. I think it's going to be a big deal.
You're not alone. It might be the only deal of the week.
I think that's the reason why it's the big deal. And I just wonder where the market is more potentially caught off sides. Is it an upside surprise or is it a downside surprise?
Let's give you an update on stories elsewhere before we get to that. With your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The White House has pulled the nomination of E.J. Antoni to lead the Bureau of Labor Statistics. His nomination shows signs of faltering due to criticism from senators and economists. A White House official said the administration looks forward to nominating a new candidate soon. The brief relief for homebuyers is officially over. U.S. mortgage rates climbed for the first time in 5 weeks, putting a halt to the recent recovery in housing demand. According to data released by the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage jumped 12 basis points to 6.46% last week. Peloton has overhauled its hardware lineup and raised prices in an attempt to lift the company out of its multi-year slump. The new products include updated versions of its bike, treadmill and rowing machine. The fitness technology company is also rolling out Peloton IQ, a new artificial intelligence system to power the personalization. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, ADP employment data set to cross. Mike McKee's going to break that down. Greg Daco of EY will join us to go through the numbers and react. From New York City this morning, good morning.
With the shutdown, with some of the government data delay, I don't think that the Fed is going to just, totally go on pause because of that. The data is the data, whether it comes out or not. I think, though, that really is the key risk, is what does the Fed react if we don't have the data. But overall, I would say the market is in a very strong place.
That was Michelle Weaver of Morgan Stanley. That's not just the key risk. That's the key question going into Friday. Will we or won't we get that payrolls report? At the moment, it looks unlikely. So this is all we've got. An ADP report about 90 seconds away. The estimate is 51K. The previous number is 54. What kind of limitations are there around that number? What kind of read do you get on the US economy? And what on earth does it mean for the Federal Reserve when they meet at the end of this month? Going into that number, the scores look like this. Equity futures on the S&P 500 negative by 0.4%. On the Nasdaq down by 0.5%. In the bond market, your scores shaping up as follows. 2s, 10s and 30s. Your 2-year around 360. Bramo, this is it. We've got nothing else.
You know, in fairness, you could say that ADP has been more consistent than the non-farm payrolls report, where we've gotten massive revisions. So arguably, this is actually really high quality data that can give us a sense of just whether it's still on the stasis or whether it's falling off a cliff. Why are you both laughing?
Because it feels like someone from ADP just shot you an email.
Exactly. You took an ADP pill. It's not just ADP. Actually, they didn't send me a message. Full disclosure.
ADP pill was given to Lisa this morning.
Well,
it's not the Lisa of last year.
The ADP pill has been given to all of us because we don't have anything else.
We've got ISM as well.
That's true.
I think that's going to be important too.
I agree.
If you're pricing in that reacceleration in equities and in credit too, you need to see some evidence of that now going into the fourth quarter.
ADP collects the receipts. They process all of the payments. So they are seeing something on the ground, and it's the keyhole we're looking through this morning.
It's nice to have you on board. All right. So the data looks like this. The estimate is 51K, the high is 80, the low is 25, with the actual number is Mike McKee.
Well, we are waiting for the number to drop here. It is going to come any second, we hope. We're counting on ADP because we're not probably going to get the non-farm payrolls number, and it hasn't hit yet. So that's not good news for ADP or for anybody in the markets. But we will say that you go to war with the army that you have, not the army that you want. So it is ADP that everybody is going to be focused on, along with a little bit later the ISM manufacturing numbers, and the ISM in a couple of days, the ISM services numbers, get some sort of read on what people are saying about the overall labor market. Now, right now, we still haven't seen the ADP numbers pop up. So.
Mike, they had one job. This was their big moment. This was it. ADP. It's what everyone wanted to see. There it is, Mike. Give it to me. It's not nice. It's not good.
Contraction, not good. Negative 32,000 is the headline number for ADP, which is obviously the worst in quite some time. Goods producing jobs down by 3,000 within that category. Construction off by 5,000. People have been waiting for that. Manufacturing down by 2,000. 28,000 service industry jobs, ADP says, were lost. 19,000 in leisure and hospitality, and professional and business services down 13,000. The only real positive category is education and health services, which is always the big hiring place. 33,000 on the month. As far as pay insights, median change in annual pay for job stayers was up 4.5%. If you change jobs, you got a 6.5% raise, they said. So this is where we are. And last month, by the way, revised down to a 3,000 negative job print instead of 54,000. You know, if we had these numbers and then we're getting non-farm payrolls on Friday, you'd see a lot of people maybe starting to change their forecasts for Friday and lower them, because this is not a good number. And we have seen ADP, as Lisa was saying, get a little bit closer to the overall numbers on a month-by-month release basis than the BLS until those revisions come in.
Mike, you're a pro, as always. Appreciate the breakdown and the tap dance. Mike McKee there with a job number. That's a big downside surprise. That's a disappointing number. And you've seen the bond market respond to it. We're down by 5 or 6 basis points at the front end of the curve. 2's back to 355. 10's down by 4.1%. That's a big disappointment. And if you were concerned about the step down in payrolls growth, I think that's more fuel for concern off the back of that report.
Yeah, at this point, we're looking at a 95% chance that the Fed is going to cut rates at the October 29th meeting in Washington, D.C. on the backs of this report. You also just saw the lowest reading on this ADP print going back to March of 2023. So definitely signaling some weakness. And essentially, this gives ammunition to those who are saying the risk management tool here is catering to the labor market, not necessarily trying to tackle inflation.
Greg Daco of EY is with us around the table. Greg, good morning.
Good morning.
This is all we've got. How useful is this number, and what are the limitations around it?
Well, I think it's useful in the sense that we don't have anything else. I would push back a little bit on the notion that the ADP is necessarily the best gauge of BLS reports when it comes to employment, because it's just focused on the private sector. It also does not include all the details that we get out of the employment report. So it is a good reading in terms of having a perspective on the labor market, but it excludes some important parts of the labor market, including the public sector, where we're anticipating some further losses, both at the federal level, but also at the state and local level, as we start the new year with less funding for many state and local governments. So I think the weakness is apparent in terms of labor demand in the labor market more broadly, whether you look at continuing claims for unemployment, whether you look at yesterday's data on job flows, the JOLTS report showing the hiring rate and the quits rate at a 10-year low, not just a few months low, but a 10-year low, showing there's very little flow in the labor market. There is underlying softness in the labor demand components. And the labor supply, of course, has been tremendously affected by the reduction in immigration. So it's a combo, but I think labor demand is weaker than labor supply at this juncture.
Are you saying that we've been sort of in this stasis, low hire, low fire range for a while, and now we're actually seeing the labor market break to the downside?
I think there are certainly risks to that. The low hire, low fire environment is not sustainable. It's an uncomfortable balance. You rarely stay in that balance for a prolonged period of time because either one of two things happens. Either you see employers starting to hire more, that's the good story, that's a positive story, or you see more layoffs because essentially there's a desire to manage costs. And let's not forget, we are still in the midst of an environment where there are a number of supply shocks affecting the economy. Too many people are still reading the economy as if it were guided by demand shocks. This is not the case. Supply shocks are increasingly important, whether it's tariffs and trade disruptions, immigration disruptions, energy disruptions, capital disruptions. All of those factors are affecting economic trends in a way that we haven't seen before. Think of technological shifts as well, AI, a big shock to the economy. We're not reading the economy in the proper way, and that's why many people are confused about the economic signals. The mixed signals are the reflection of an economy that is impacted by a significant number of supply shocks.
Yeah, and essentially, this is an economy in dramatic transformation. I just wonder how you square the idea of profits growing across Wall Street, across a lot of corporate America, at the same time that we see this low hire, low fire dynamic potentially breaking to the downside.
Because everybody's thinking about the consumer, about the market, about the business environment. It's not like that. There is a tremendous degree of polarization across businesses, across consumers, across the economy when it comes to how these shocks are affecting different actors in the economy. Take tariffs. Tariffs are not affecting everyone in the same way. Those that are very price sensitive are seeing the prices at grocery stores rising, and they're pulling back on demand. They're seeing retail costs also rising. They're pulling back. Those that are at the higher end of the income spectrum, they're less concerned about an increase for a price ticket to go somewhere, to fly somewhere on vacation. But they're also gradually being more cautious. And the same applies to businesses. Not all businesses, not all sectors are created equal in the face of the supply shock. If you're more heavily leaning towards the tech sector, then you're going to be benefiting from this AI boost. If you're a big corporation that is investing in AI, you're also going to be investing more in CapEx. We're seeing that in the GDP data. So it really depends on where you lie on the spectrum of the economy and how exposed you are to these shocks.
Greg, what if we get a prolonged government shutdown and this is all the Fed has to go off of?
Unfortunately, this is not the best time to have a government shutdown. Of course, there is the immediate effect of essentially 800,000 federal workers not being paid and being put on furlough. That can have a notable impact on the economy. We estimate a drag of about 1/10 of GDP growth for every week of government shutdown. But importantly, for business leaders, policymakers, and economists, this means we're flying blind in a highly foggy environment. And this is very risky.
Can we get a shutdown-induced recession in some pockets of the U.S. economy?
Perhaps in some pockets of the economy, but not necessarily broadly speaking. This is not significant enough to really bring the economy to its knees when it comes to a potential recession. But we are seeing some sectors that are seeing outsized declines in terms of economic activity. You look at the housing sector, for instance, a sector that is also hit by insufficient supply, but increasingly by the drag of demand from a low affordability environment. if you start to see more segments of the economy affected negatively by government shutdown, think about the area around D.C., think about contractors that depend on federal funding, then that could put further downward pressure on a housing market that is already struggling. So regionally and sectorally, you could have these pressures that are outsized and that weigh on economic activity. Not a broad-based recession, but a more pronounced slowdown and potentially a contraction in some sectors, some regions of the country.
If you are just joining us, welcome to the program. Just moments ago, the ADP report, of course, taking on additional importance this week because we might not get the payrolls report this Friday, came in at negative 32K. Negative 32K. We were looking for 51,000 in our survey. That was the median estimate. A revision to the previous month as well. That was 54. It's now negative 3. Greg, just got this question from a Bloomberg subscriber. They said the cycle is always stop spending, stop hiring, then start firing. And the question they've got is the natural progression always the same in a slowdown? Is it any different this time?
I think it's very different this time around because we're affected by supply shocks. Supply side dynamics are very different this time around than they've been any time over the past few decades. And I think that's why you're seeing these unusual evolutions when it comes to the different sectors of the economy. We have rarely seen a low fire, or even no hire, no fire type of environment. That is not a comfortable balance. Again, I think we are likely to see further weakness on the labor demand side. That's going to weigh on economic momentum. One key indicator that I watch, I know it's a lagging indicator, but it's income growth. If you look at real disposable income growth, it's only been growing at a 2% pace. Consumer spending still growing close to 3%. At one point, the dip into savings is not going to be sufficient to sustain spending, and the minority of people that are still doing most of the spending cannot do so forever. The higher income individuals are also gradually being impacted by higher prices and, importantly, by higher interest rates. If there starts to be some volatility in the equity market because of a government shutdown or because of other developments, then that could weigh on these individuals' desires and potentially means to spend.
Greg, it's good to see you. Thank you,
Always
sir.
a pleasure.
Greg Daco there of EY. Mike McKee still with us. Mike, I've got about 30 on the clock. I know you wanted to jump back in.
Yeah, we've got an important note from ADP here that you remember when the BLS revised down its job creation numbers for the last year, ADP did the same thing. And they say the September number is 32,000, but a loss of 32,000 jobs. But the overall reduction from the revision was 43,000 jobs. So now it's even more confusing.
Mike, you can bring some clarity and maybe settle down some nerves in about 5 minutes' time. We'll be back in a second. Coming up on the programme, Tiffany Wilding of Pimco with future economic data in jeopardy following that government shutdown. Their conversation up next. The opening bout is about 60 minutes away. Moments ago, 15 minutes ago, we had the ADP report, a downside surprise, negative 32K. The estimate was 51. The revision to the previous month, not great either. The stock market's down about 0.4% on the S&P. That's largely where we were. In the bond market, though, an additional bid, a rally, particularly at the front end of the curve. Yields down by more than 5 basis points. The 2-year at 3.55. So that's the cross-asset picture, stocks and bonds. Let's get you some single names, some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with the power company AES. Shares are surging 11% on our reporting that BlackRock Global Infrastructure Partners is in advanced talks to buy the company. AES is valued at about $38 billion, including debt, but it has lagged its peers, making it right for a buyer that believes AI will continue to drive demand for electricity. Meanwhile, moving on to Peloton, those shares are up 3% after it just made its first major moves under new management, which as they try to lift the company out of a slump that has lasted for years. So they raised prices and also introduced updates to its bikes and other workout machines, while also rolling out Peloton IQ, which is an AI system for personalized coaching. And after that workout, you're gonna need some protein, which leads me to my next stock, Cal-Maine Foods. This is the largest egg producer in the U.S. Shares are plunging down 10%, even after the company reported its strongest first quarter ever, but they fell short of analyst estimates. Still, egg sales were strong, driven by higher prices and higher volumes, and the company says that's all thanks to soaring demand for protein. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Some of the movers going into the opening bell about 59 minutes away. Moments ago, we got that economic data, ADP coming in softer than expected. Mike McKee mentioned this. I think this is an important note, what it could mean for payrolls, what any of this would mean for payrolls on Friday. If you're interested in what the estimate actually is for payrolls on Friday, Lisa, it's still 52,000. The median estimate, the high is 129, the low is minus 20. You'd imagine all of that would shift lower after a number like the one we just got.
Especially given what Greg was talking about, this is private payrolls. If private payrolls shows this kind of weakness, and Kevin Gordon over at Charles Schwab points out that construction jobs declining by 5,000 is the lowest going back to 2020. If you're seeing that in the private sector, throw on top of it the public sector where there are a bunch of cuts going on, and it probably would be even worse. So it raises a question of, is it really potentially pointing to even more downside over for non-farm payrolls?
Let's get to Mike McKee now for more. Mike, welcome back. You've had a second and a third look at this number. Help us understand what's behind this all.
I wish I could. I said you go to war with the army that you have rather than the one that you want, but what if you can't count the army correctly? That seems to be the case here. ADP has said as part of this report that they use the QCEW, the quarterly census of employment from the BLS that is done to incorporate unemployment insurance claims so that it's more accurate. You remember 900,000 jobs were taken away in the past year from the NFP numbers, but the government doesn't apportion those by month until January. ADP has done it now. And so while they're saying there was a negative 32,000 jobs created, they also say they subtracted 43,000 jobs from the month because of the revision. It also had an impact on August as well, which is now a negative 3,000. The chart I was just showing there was how the non-farm payrolls private numbers and the ADP numbers, how much they missed by. And you could see they'd gotten a lot better, but I suspect this month is going to be kind of difficult to figure out if we get an NFP report because of this revision by ADP. You had a chart, showed what we'll miss. Construction spending gets the honor of being the first report that probably doesn't come out. Tomorrow, jobless claims. Reuters reporting that we will not get jobless claims. We're going to keep an eye on that. The Labor Department hasn't put out a release on it yet. Factory orders, then the jobs report, and then, of course, CPI and the third quarter GDP numbers, two big numbers coming up that we won't get. And the longer-term threat of all this is that there are going to be things that can't be measured if this goes on long enough. Get past the week that includes the 12th, and you won't get data collected for October jobs. And if you go maybe another week longer, you won't get enough data for the October CPI. So there are some real issues here with the government shutdown and data. We can hope it's short and that they can get all this stuff out very quickly.
We can only hope. Mike, thank you. Thanks for explaining all of that. Mike McKee with the latest. Tiffany Wildiger, Pimco, joined us now for more. Tiffany, welcome to the programme. Let's say this is all we've got. And there's a lot still to play for in October. It's only just started. I've got no idea how long the shutdown goes on for. But let's say this is all we've got. Is there anything in here that would stop this Federal Reserve from just cutting interest rates again at the end of the month?
No, I mean, so I think clearly this ADP report was weak, and I think digging through the details of it, I think there's an interesting bifurcation in large versus small and medium business sizes. This has been something we've been very focused on because we think that this economy is basically creating winners and losers. The tariffs, the technology improvements that we're seeing, the various tax cuts, all of that we think is benefiting somewhat more larger companies, and it's a really challenging environment for those small and mid-sized businesses, and that's where you saw the some more of the weakness. I think that in terms of the ADP report, the fact that it contracted, if you adjust the payroll survey, the government survey for the overestimation in that survey over recent years, you can get to numbers that look like they were contractionary over the last 3 months as well. So I think these surveys are given a consistent signal that we are seeing some more concerning weakness in the labor market.
And so right now you're seeing priced into the market 101% chance of a 25 basis point rate cut at the October 29th press conference and meeting. And then in December, again, almost a 100% chance, 88% chance of another cut. I just wonder, Tiffany, is that the solution to what essentially is the K-shaped economy that's getting to be an even bigger K?
Yeah, I mean, so I think that's right. There is, I think interest rate cuts as a result of the fact that the shock that we're going through right now is both a demand and supply side shock. Tariffs and both immigration will have supply side effects as well. And of course, central bank policy is not well suited to deal with supply shocks, but nevertheless, policy is in restrictive territory. And, I think when you're in an economy that is going through this type of transition, given the policy U-turns, arguing that it's closer to neutral is certainly very reasonable. And I think the interesting thing that we're seeing, since the implementation of tariffs is that the adjustment that the economy is making to tariffs is not primarily through price adjustments, but it actually looks like it's happening through the labor market as well, as companies are trying to cut labor and other costs. So that just means, we think that means the Federal Reserve has room to cut interest rates here. They still have rates that are above neutral. Getting back to that is very reasonable in our minds, given the weakness of the labor market we're seeing.
This is really a strange moment where you're seeing companies adapt and adjust to the tariffs by potentially cutting workers. That's what you're saying, not just raising prices, and yet continuing to report really good earnings, continuing to really deliver and highlight the strength of the consumer. Can you square that circle? I mean, how does that make sense? The fact that the consumer is strong, layoffs are happening because that's the way the companies are dealing with this. And so the companies are profiting. At some point, does that flywheel stop going?
Yeah, well, I mean, I think it gets back to your point on the K-shaped economy. So we see it on the business side as well. I think the largest businesses, that primarily make up the S&P index, for example, I think they're the relative beneficiaries of these various policies. So you have pretty large tax cuts that were also passed in the One Big Beautiful Bill that that will benefit companies that are relatively capital intensive. They do a lot of CapEx. They'll get upfront expensing for all of that. And if those companies, can offset those tax cuts, offset the tariffs that they now have to pay, they're in a pretty good position. The smaller and mid-sized companies that maybe have less CapEx will be in a worse off position. So, I think those are the companies right now that are facing the most pressure. The broader indices of smaller companies like the Russell, for example, it's not done as well. Those equities have not done as well this year. I think very reflective of that theme. And I think the real question for the broader economy is how, I would actually argue we're not seeing a huge amount of layoffs yet. What we've seen instead is that the gross hiring rates have declined, very tremendously. So the question in our minds is, how these struggling businesses, how much will they lay off labor over the coming months, and will that cool off the broader economy?
So, Tiffany, can you see Fed officials arguing that instead of tariff-induced inflation, we can have labor market weakness that's tariff-induced? And shouldn't those that are concerned about the tariffs actually be on board with now wanting to cut rates?
Yeah, I mean, I certainly think that's the argument that we're making. And I think that as you get more data, that you will see more and more Federal Reserve officials coming around to that argument as well. I think Mary Daly in recent public comments has made that data. Of course, Christopher Waller, Governor Waller, has also come out with some pretty big concerns about the labor market. So I think that, yeah, certainly as we get more information and you have more certainty within the FOMC, we think they cut interest rates a couple of more times this year. As a result of that, now, of course, the government shutdown, the fact that we potentially aren't going to get data releases, or the data quality could be poorer over the next couple of months before we go into the November meeting, could be problematic. But again, of course, the ADP data that we've gotten, some of the other private sources of data will be more important, and that's what they'll be using.
Besides the fact that we're not going to get economic releases, how concerned are you about the government shutdown?
Well, I mean, traditionally, government shutdowns have just a temporary effect on the economy. The workers that are furloughed or that aren't paid, ultimately, when the government opens, will get back pay. So this is usually just a temporary effect. It's possible that we could have a longer shutdown. We would argue that the effects start to get nonlinear after you get workers, contract workers and government workers that start to miss a couple of paychecks. I think one paycheck probably okay, but as you get more that are missed, then that's when you start to see a bigger impact on consumption. The other thing is that there could be permitting delays. The government, does give out permits for investment, and the longer that those kinds of services are shut down, you could see some delays in investment as well. So, ultimately this can get larger as time goes on. I think the largest government shutdown historically has been, maybe a couple of weeks. We hope that's the case again. But, and as of now, we think this is a temporary issue, but certainly we're monitoring the situation.
That sigh resonated with us all. Tiffany, thank you. Tiffany Wilding of Pimco. Tiffany, thank you so much. I think it resonated with most people in this market. If you're just joining us, welcome to this programme. So we've got a government shutdown. We don't know how long it's going to go on for. There's a big question mark now over the release of jobless claims on Thursday, a big question mark over the release of payrolls on Friday. So this is what we've got to work with. ADP and a big downside surprise, negative 32K against a median estimate of 51.
Look, it sounds like it's all confusing, but what it is clear, and I think that Greg Daco put it really well, and I think that Tiffany Wilding put it really well, which is that on the margins, companies aren't hiring, and to the extent that they are laying people off on the margins, that's showing up because the whole pool of workers isn't as big. I'm just struggling with, yes, we're all exhausted, but there's a very real issue here. The Fed has a hammer. Sees something, it has to be a nail. But ultimately, the K-shaped economy is not going to go away with rate cuts. What it's going to do is it's going to increase the asset price inflation that we've already seen, even if it doesn't increase the inflation in the underlying economy. How do people grapple with that? Well, Max Kettner's buying into stocks. And if you can, that's what people are doing.
And he's not alone.
Exactly.
And they're buying gold. Gold in the S&P. Gold in the S&P.
Yeah,
and that's worked well so far this year.
At some point, this breaks down, though, because at some point, what are the limits of that K-shape, whether it is a political response or whether it ends up being something that has to come from legislation?
5 years in the making, at least over the pandemic and post-pandemic, but some might say it's decades in the making. Well, post-GFC and the central bank response to that.
And how much does the AI transition accelerate that, given the fact that companies are finding, oh, hey, guess what? I don't need a secretary to do that for me. I don't need an entry-level person to do that for me. Hey, ChatGPT, what should I wear today?
Some of that's going on. Have you asked that question, have you?
No, never. Ever. Absolutely not.
Sure,
I don't believe it.
I don't believe you now at all. Bond yield to lower this morning by 6 basis points. The 2-year at 354. 10's down 5 at 4.1%. Let's get you an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Well, let's recap the data. Private payrolls unexpectedly dropping in September. ADP data showed private sector payrolls down by 32,000 last month. Economists surveyed by Bloomberg were calling for an increase of 51,000 jobs. Goods-producing jobs fell by 3,000. Service-producing jobs were down 28,000. Walmart is planning to remove synthetic dyes from its store-banned food products in the US. The world's largest retailer will also eliminate 30 other ingredients, including some artificial sweeteners, fat substitutes, and preservatives. Excuse me. Which will apply to all store-brand food and beverages. The changes go into effect by January of 2027. And that's your Bloomberg brief, John.
I appreciate it, Vonnie. Thank you so much. Vonnie Quinn there with the latest. Up next on the programme, we'll set you up for the day ahead. Plus, Vivek Arya of Bank of America Securities as Big Tech's AI spending spree continues. That conversation up next.
Push back a little bit on the notion that the ADP is necessarily the best gauge of BLS reports when it comes to employment, because it's just focused on the private sector. The weakness is apparent in terms of labor demand in the labor market more broadly. The low hire, low fire environment is not sustainable.
That was Greg Daco of EY following this number, negative 32,000 on ADP. The estimate in our survey, 51K. Some negative revisions in there too. Stocks were softer going into it. Stocks look like this now. We're down by 0.4% on the S&P, but there was a turn in the bond market. Yields just took another leg lower. If you look at the front end of the curve, 2's down by 6 now. The 2-year at 354.70. Typically, you might not see a move like this off the back of data like that from ADP. But this takes on additional importance because we don't know if we'll get the payrolls report this coming Friday. This is what it looks like for the week ahead. The trading diary is shaping up as follows. So we will get the PMIs. We will get ISM. Look out for that a little bit later this morning. We might not get jobless claims Thursday morning. So big question mark around that. And a big question mark around the big one. Will we? Won't we? Maybe. The payrolls report coming Friday morning at 8:30 Eastern Time.
Yeah, so this is what we've got, and right now it looks pretty bad. Andrew from Alliance Bernstein, Andrew Brenner, came out and said that this is the biggest 2-month decline that we've seen in ADP going back to 2020. A lot of 2020 comparisons, given how good the labor market has been until then. And it raises the question, why is bad news in the labor market not bad news for an equity market, or not worse news for an equity market that has been, to use Tom Keene's word, ascendant for the better half of 2025?
Because the Fed is driven by this story in the labor market, and the equity market is driven by this. In the stock market, Nvidia, a market cap surpassing a record $4.5 trillion after a slew of recent deals. Vivek Arya of Bank of America Securities reiterating its buy rating following Nvidia's $100 billion investment in OpenAI, predicting the investment could generate $300 to $500 billion in revenue. Vivek joins us now for more. Vivek, welcome to the program. It's always good to get your perspective. You've heard the complaints, financial engineering, circular finance. How are you framing these announcements of the last month?
Sure, John, I think that, we are incredibly positive on the AI infrastructure deployment cycle. I think we are just in the first, few years of what could be a 10 to 15-year cycle of essentially remaking the world's infrastructure from traditional to accelerated computing, and then generating a ton of insights from all the data that is just sitting out there. And semiconductor companies are extremely well positioned to benefit from the early part of that deployment. And I think NVIDIA is the best of the bunch because it has the best turnkey model to benefit from this infrastructure deployment. Now, in terms of the complaints about investing in their customers, I do think the optics are questionable, no doubt about that. But then if you step back and say that if the overall deployment is going to be multiple hundred gigawatts over the next several years, what NVIDIA is investing in is maybe 10 gigawatts, so less than 5% of that overall deployment. And the second point to consider is that it's not like they're just handing over free GPUs to OpenAI. For every GPU that they will, for every investment that they will do in OpenAI, or $10 billion of investment, OpenAI will have to go and raise another $30 to $50 billion to complete that installation. So that's why I think you have to look at the bigger picture, that this is a way for NVIDIA to push what is probably the most disruptive force in AI deployments. And I think it has a force multiplier effect on the overall infrastructure deployment cycle.
I think the thing that concerns people, Vivek, is that a lot of people are looking at the big picture. They're looking out 10 years. They're looking out 20 years. They're getting incredibly excited. They're saying, let's all price it in now. How much of the entire story for 10 years has been priced in without necessarily seeing the percolation into the rest of the industries throughout the S&P 500, Russell 2000, et cetera?
Sure. No, I think it is true that, the market capitalizations of many of these companies have increased considerably in a short period of time. But we also have to consider that the amount of capital spending has also increased commensurately. If you look at this in terms of traditional valuation metrics, NVIDIA today is trading at maybe about the same multiple as the day ChatGPT was launched in 2022. So it was trading at about 30 times forward earnings that day. And it is still trading at about 30 times forward earnings, despite the tremendous amount of growth potential ahead. If we think of this in terms of price to earnings growth, the S&P 500 is trading at 2 times its earnings growth. NVIDIA is trading at less than 1 times its earnings growth. So I think based on traditional valuation measures, we think that the stock is still incredibly cheap, and not just NVIDIA. I think there are a number of other companies in the semiconductor sector that are trading at about 1 times earnings growth, well below where many of the large cap growth companies are trading at, or where the S&P 500 is trading at. It's really about what is going to be the pace of CapEx deployments. And our view is that as long as there is this disruptive force such as OpenAI that is able to impact the social, the cloud computing, the consumer, the enterprise models, it is going to keep the pressure on every other hyperscaler to invest. And we think these semiconductor companies benefit tremendously from that.
Vivek, just real quick here, what would you see that could potentially raise the red flag that there is something that seems a little overly exuberant or frothy or bubblicious about this sector?
Absolutely. I think it starts and ends with capital spending. I think that's what we pay the most attention to. It is not the daily headlines around China. It is not the headlines around this model is better or that model is better. Follow capital spending. And when you look at the commentary from the largest companies on the planet, which are the US hyperscalers, every move that they are making in capital spending is up and to the right. That's what we focus on. And as long as those companies are able to justify the amount of capital spending, as long as they are able to see whether it is the competitive forces that are pushing them to do so, whether it is the ability to generate new sources of revenue growth that are pushing them to do so, it doesn't matter. As long as their capital spending tap is on, I think the companies that we follow are extremely well positioned. Of course, not every capital spending cycle is always a straight line. There are going to be invariably periods of digestion. It's just hard to know when those periods of digestion happen. So follow the line of capital spending, follow the moves of these hyperscalers in terms of, asking for more computing capacity, more data center capacity, access to power. I think those things matter a lot more than, as I mentioned, the daily noise around, large language models or talks of bubble, etc. Follow capital spending. That's the most important thing.
Vivek, appreciate your statement. Your perspective, as always. Thank you, sir. Vivek Arya there of Bank of America Securities. I remember not so long ago being on $1 trillion watch. And here we are at 4.5 trillion. Nvidia, Microsoft 3.85, Apple 3.8, Amazon 2.3, Meta close to 2, Broadcom above $1 trillion. You've got Alphabet close to 3. The numbers just go on, and they're getting bigger and bigger. When
you compare them to the GDP of entire nations, it starts to look like it's their world. We're just living in it.
It's pretty crazy, isn't it? Coming up tomorrow, Kelsey Barrow of JPMorgan, Sarah Hunt of Empire Saxon Woods, Mike Pyle of BlackRock, Biggie Charter of Deutsche Bank.